Why the change in non-farm payroll is at 216,000, way above consensus, above last period, and average hourly earnings growth of 0.4% better than expected. Why that's not a strong labor market?
Yeah, so that's a completely sensible question. I think, in fact, that is the key question. And the way we answer it is that, number one, the non-farm payroll usually over time is a reliable indicator of what's going on in the labor market, but in real time, it's not. And the reason why is that BLS relies on this model called birth and death model to supplement the surveys. And in 2023, even though non-farm payroll says that the job market added 3 million jobs, in fact, 42% of it is due to a model that says that new jobs from new firms formation create more jobs than the amount of firms going bankrupt. But that just doesn't match what you see out in the real world, which is, record high bankruptcy rate since 2010, and many small firms complaining that they can't hire, right? And the second point about why wage growth is still elevated is we just came out of a UAW strike where manufacturer workers negotiated over 20% of pay raise. We also see fast food workers in California seeing a huge pay raise. And as we go into the new year in January, many of the minimum wages will reset. And we have found that 28 states have indexed the minimum wage to inflation. So what you see in robust wage average hourly earnings could be reflecting these resetting of wages. But, let me say this. If the Fed is right about inflation expectations being anchored and consumers are now seeing more stresses in their balance sheet, it means that firms won't be able to pass on those higher labor costs to prices. And what will happen is that as a result of those hikes in minimum wages and, union strikes wages, they will have to lay off more people. And that's exactly what we're seeing in the big three auto industries after they settled with the union.
Got it.
Anna, was there a wild card here? I mean, did the holidays, seasonal factors, did anything like that play a role?
Oh, definitely. And that's why the non-farm payroll headline was so strong. One of them is construction. So usually construction workers take a hiatus during the winter because it's too cold. And, last year there was a winter storm in December in California. But this winter we have El Nino, and that's causing an unseasonably warm winter in the East Coast and northern United States. And that is actually good for construction employment and also leisure and hospitality and retail. So I think that's the reason why the seasonal factors were not able to completely correct for the weather-related boost to employment.
Hey, Anna, what's the Bloomberg Economics model say about GDP growth in 2024 right now?
Yeah, well, I mean, this is more of our judgment. So we expect 2024 to see a very mild downturn in Q1 and Q2, and then a recovery in the second half. So all in all, a growth rate of about between 1% to 2% in 2024.
Hey, Anna, I can't help but notice, and then for our YouTube viewers, behind you, Anna, there's like a pirate flag in your office. What does that mean?
Oh, yeah, it's actually gifted to me from one of our very esteemed colleagues in the newsroom that covers the Fed. And apparently it's been a sign of bipartisanship and objectivity in the coverage of economics news by Bloomberg reporters all these years. And they used to fly this pirate flag to reflect that. And now he has gifted it to me.
I thought it was just that you were bearish in Bloomberg Economics and the pirates.
We need a flag here.
Yeah, we need one here in our Bloomberg studio. All right, Anna, thanks so much for joining us there. Anna Wong, she's a chief U.S. economist for Bloomberg Economics, doing extraordinary work there on their economic forecasts, inflation forecasts. Boy, I tell you what, going back a couple of years, they were first on the street saying the Fed was going to raise rates, and boom. In 2023, we had a 525 basis point increase in the Fed funds rate, and Bloomberg Economics was first with that call. So some good stuff there. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, the risk of attacks on the Red Sea is too high for a giant shipping company to set sail again. We get more on that from Bloomberg's Jeff Bellinger.
Steve, Maersk does not expect to resume shipping on the Red Sea anytime soon. The company paused transits in the region earlier this week, saying it would assess the situation. The evaluation by Maersk determined there is still a significant security risk to ships, and the company says it will continue diverting ships away from the Red Sea for the foreseeable future. That means vessels that normally use the Red Sea will sail around the Cape of Good Hope. Shipments will be delayed, but there is more assurance they'll arrive. Steve?
Thanks, Jeff. OpenAI is planning its own online store with a launch coming next week. Bloomberg's Joan Doniger reports.
It would let you share custom versions of the company's GPT chatbot, so you could be able to do that without having to learn coding. The store would allow the company to make money, like it would with apps in Apple's App Store. The company made the announcement in an email sent to some users.
Joan, OpenAI planned to introduce the store in November, but delayed the launch, citing the interruption caused by the ouster and rehiring of CEO Sam Altman. And Tesla recalled virtually every car it's ever sold in China due to issues with the driver assistance system autopilot that increases the risk of crashes. The car maker will deploy an over-the-air software fix for more than 1.6 million vehicles that were produced between August 2014 and December of last year, including locally built models such as the Model 3s and Ys. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 10:22 on Wall Street, I'm Nathan Hager. We are on Friday rally mode for stocks and bonds after weaker than expected ISM services data offset stronger than expected jobs data. Now the Fed swaps market is making it 70-30 odds that we get a March rate cut from the Federal Reserve. But let's check the markets as we do all day long here on Bloomberg. Right now, the S&P 500 is up 0.5%, up 23 points. The Dow Jones Industrial Average up 101 points, a gain of 0.3%. The NASDAQ Composite is higher by 76 points. That is a gain of 0.5%. Every sector that's all 11 main industry groups in the S&P 500 are in the green at this moment. So are treasuries. The 10-year is up 8/30 seconds. The yield now down to 3.96% on the benchmark treasury note. NYMEX crude is up 2.4% at $73.89 per barrel. COMEX gold is up 0.9%, $2,068.40 per ounce. The euro 1.0982 against the dollar. We're keeping an eye on Apple shares on a 4-day losing streak. Right now, they're little changed. The world's most valuable company is hoping to hold on to that title. We're also watching NVIDIA. Analysts at Bank of America say the AI chipmaker has strong upside potential with a position supporting robust free cash flow. And right now, NVIDIA shares are higher by about 1.8%. Just for you, Paul Sweeney, Peloton is up 14%.
Boom. Darn right.
Mirroring the 14% gain from yesterday on that partnership with TikTok. Maybe you'll get on that social media thing after all.
I don't think so.
That's
I've done live.
business.
I've done live rides at the Peloton studios in New York City, though.
Oh, there you go. That's all
Yeah.
the FaceTime you. Absolutely.
That's all I need. I'm
Impressive.
with Jen Sherman. Yeah, it's awesome. Good times. Nathan Hager, thanks so much for that report. We appreciate it as always. Lisa Mateo, Paul Sweeney. We're live here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio, and that's where you'll find us. Ben Emmons joins us here in our Bloomberg Interactive Broker Studio. He doesn't mail it in or phone it in. He's a principal senior portfolio manager and head of fixed income at New Edge Wealth. Ben, lots of economic data today and really this week here. I don't know. I mean, this services data kind of took me by surprise here. Again, the ISM services data, and we talk about services, it's important. It's 70% of our economy. Came in at 50.6, so it's still above 50, still showing some expansion in the economy, but well below last month and well below the consensus of 52.5. That's kind of got the bonds here, yields coming in a little bit and stocks higher. What do you make of that services data?
Yeah, Paul, I thought that the surprise there was that employment component, dropping below 50 pretty sharply.
Yep.
I think that triggered the rally in bonds, because it's a bit contradicting to what we saw yesterday with the PMI services data. Now, these surveys are a little different from each other, but nonetheless, in the employment component, that survey was up. And it was actually, I think, part of the reason why we saw better payroll data this morning. And so I guess this survey is indicating that, some of the people in the supply management survey view that the economy is perhaps getting weaker or they're having less demand for labor. Either way, you're getting this whipsaw on the market this morning. Yield goes up to 4.10 on the 10-year on the payroll report and reversed back down to 396. So I think what it tells us is that this is a good economy. There will be some rate cuts coming in the future, but it is not like a recession economy either. So you're not seeing much lower yields, I think, from here.
Yeah, so Ben, let's get into the rate cuts that you talked about, because we have the jobs data, we have ISM. You also get research from Wall Street firms, from banks. So when do you see these rate cuts possibly kicking in?
So I think the March rate cut is probably too soon, and that's just because the way the Fed has communicated it so far. They've given us an idea that they are having projections out that probably gives them the confidence that they actually this year can lower rates compared to last year when they said resoundingly like there's no case for rate cuts. But a March rate cut would mean that the inflation data we're getting out until that time would see such a significant decline that they start reacting to that and then make the case that March is the live meeting. So I think from here, Lisa, it will be more about, as we're getting several months of inflation employment data, and it continues to go towards the goal that they have, 2% inflation and unemployment rate maybe a little bit above 4%, that it probably is more closer to June to get the first rate cut. And then we really are into the second half of the year, so I don't think you're going to see 6 rate cuts this year.
So, Ben, what did you make? We haven't spoken to you in a while here. What did you make of that big move we saw in the markets there in the last 10 weeks of the year last year? We just had the 10-year go from 5% to 3.25%. We had the stocks just rip. I mean, what was that?
Yeah, that's actually the right way to say it. What was it really about? Was it just about yields going down because one CPI report showed that the owner's equivalent rent finally starts to decline? I don't see it in New York, but okay, it's finally declining, so that triggered the move down in yields, and it was a relief, and you're getting all the high beta and small caps and everything start to price in this idea that, the economy's not going to go to recession, it will be a soft landing, maybe even no landing, I think, because it's just simply an economy staying on track. And at the same time, it's about those who had money on the sidelines redeploying in something that lagged relative to technology. So sort of a relative catch-up that I think what drove this rally. Now, will it continue is to be seen, because I think what we're coming into this year is that we're going to keep the Fed still restrictive for a bit of time. So the economy, if it does stay in a slower track than last year, you may see stocks not perform so strongly as we saw last year, as yields to sort of stay where we are. And I think that's a really important part about that story. Ultimately, it's all about interest rates.
Now, but a strong jobs market, it's that main kind of engine for resilient consumer spending. And it's pushed a lot of economists to rethink their recession calls. What's your take on that?
Yeah, I think the recession call, I've never been in that camp. I still think there's no recession this year. There may not even be next year. I think here's where I come from on this important point to make maybe, is that the fiscal impulse that we have to the economy, fiscal spending, is not going to change this year. They have agreed on the debt ceiling last year. They have a 1% mandatory spending cut across the board. But that's so small if you think about back in 2011-12 when they had a 10% mandatory spending cut, which really slowed down the economy. 1% is just not going to do much for the economy, especially if you're seeing jobs data like this coming out and you're seeing confidence picking up and financial conditions being looser, right? So I think it's an economy that stays on track. What could change it is next year, whomever's in the White House. But here's one other thing about that White House race, the new president. Whether it's Biden or Trump, what it looks like, either of them wants to stimulate the economy, either with tax cuts or with more spending. So either way, I think this recession scenario is not going to play out unless we're getting major fiscal spending contraction. As I mentioned, I don't think that's the case.
So given that backdrop, Ben, kind of what's your best idea here coming into 2024? A lot of folks were saying, hey, just be long equity markets, but then you had that huge run up in the end of the year. Maybe some of the glory was taken out of there. What's your best idea as you think about 24?
Well, we do look carefully at new edge valuations. And, my colleague Cameron Dawson, who was on Bloomberg Surveillance the other day, she kind of made the case on that too, saying, look, we do have overvaluation in tech. And the adjustment of interest rates a bit higher from here because the economy is just better, takes off some of that valuation froth that's in there. But there was also some level of froth coming into, really high beta elements of the market. So I think you want to play it a bit more defense. We like energy, we like the utility sector, we like some of the healthcare sector. You really pick your best parts there. Some stocks are very undervalued relative to the market, meaning trading really at low multiples. And actually, their earnings forecasts are much more realistic.
So not chasing, I guess, those Magnificent Seven.
Not really.
Yep.
So to call Jeffrey's like Microsoft.
Yep.
We all know that Microsoft is a great company and it's good and strong, but you would be chasing it probably here at these valuation levels. What I like in fixed income and also I think in equity is that emerging markets is an interesting story because we are coming off really restrictive rates in emerging markets and inflation is really moderated there. There's some really good earnings growth stories, both Asia and Latin America. So I think there's an opportunity. We like Japan. There's another market that continues to be an outperformer in international equity. And then lastly, we got to watch what the dollar's going to do this year. If the Fed's going to lower rates, it's going to lead likely to a weaker dollar environment. Every time the dollar does go below 100 on the index, it leads to significant rally in energy and commodities. It's been that historically that way. I don't think it's going to be different this way. This year, and now whatever happens geopolitically, energy is, I think, a bit undervalued from where it is currently. Same thing somewhat in commodities. Lastly, gold could actually be a strong year for gold given uncertainty and Fed easing. It performs quite well in that environment.
Yeah, and just a quick, I want to get an idea of sentiment out there. I mean, you think rising interest rates makes it more expensive for companies to operate. I mean, some of your clients, they're entrepreneurs, they're corporate executives. What's the feeling that they're getting out there now?
Well, there's caution. There's this obviously, we do deal with this election, and it's an uncertainty. We also just do the Fed discussion. It's not clear, right? If you're actually going to get these rate cuts and how many, uncertainty. We're all watching what's going on in the Middle East, and we don't know how that's going to exactly play out, so uncertainty. On the other hand, there doesn't seem to be this slowdown that everybody continues to talk about, that the slowdown that tips us into a recession. So I think that our clients are more about, we like risk. We like to not be out of the market. Right? We still like some of the areas like private credit or private equity. That's not something we want to necessarily scale completely out of it because of recession risk. But we don't want you to play the high beta trade either, right? Meaning, going really in high risk really small caps, or go into crypto and things like that. We don't want to play the liquidity high risk game that way, and be mindful that we do have fixed income. We can finally get some additional income. That's still really important in a portfolio this year.
Ben Emmons, thanks so much for joining us. Ben Emmons, principal at New Edge Wealth. With our news in Washington, D.C., here's Amy Mars.
All right, thank you, Paul. Presidential candidate Ron DeSantis is in a tense showdown with former UN Ambassador Nikki Haley ahead of the Iowa caucuses now. They held back-to-back CNN town halls in Iowa last night, vying for runner-up for the GOP presidential nomination behind Donald Trump, who has a huge lead in the polls. While in New Hampshire, Haley said this about the primaries.
You know that you correct it. You know that you continue to go.
Now, DeSantis called that comment disrespectful to Iowa.
It's a slap in the face to Iowans to say that they somehow need to be corrected. It's almost as if like she's acknowledging she's not going to do well here, and so she's blaming the voters. That's unacceptable.
Haley, during the town hall in Iowa, told CNN New Hampshire, Iowa, and South Carolina banter like that regularly and not to take it seriously.
New Hampshire makes fun of Iowa. Iowa makes fun of South Carolina. It's what we do. So, I think the problem in politics now is it's just like too serious and too dramatic if we're having fun.
Haley and DeSantis also focused their attacks on frontrunner Donald Trump. U.S. officials say Russia is receiving weapons support from North Korea and possibly Iran as it continues its war on Ukraine. Bloomberg's Nancy Lyons with that story.
National Security Council spokesman John Kirby says Russia has already been firing missiles provided by North Korea at targets in Ukraine.
These North Korean ballistic missiles are capable of ranges of approximately 900 kilometers. That's about 550 miles. This is a significant and concerning escalation in the DPRK's support for Russia.
Kirby says the U.S. will impose additional sanctions against those working to facilitate any arms transfers between Russia and North Korea or Russia and Iran. He's also urging Congress to approve more aid to Ukraine. In Washington, Nancy Lyons, Bloomberg Radio.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
$10:40 on Wall Street. I'm Nathan Hager. I want to pass along some headlines from an interview Treasury Secretary Janet Yellen is giving to CNN off the back of the stronger than expected December non-farm payrolls report. Secretary Yellen says the U.S. has achieved a soft landing, and the hope is it can continue. She goes on to say the economy suggests the Fed has made good decisions. Moments ago, we spoke with Ben Emmons, Senior Portfolio Manager at New Edge Wealth. He says the data that have been coming in don't support a March rate cut.
A March rate cut would mean that the inflation data we're getting out until that time would see such a significant decline that they start reacting to that and then make the case that March is the live meeting. So I think as we're getting several months of inflation employment data and it continues to go towards the goal that they have, 2% inflation and unemployment rate maybe a little bit above 4%, that it probably is more closer to June to get the first rate cut. And then we really are into the second half of the year, so I don't think you're going to see 6 rate cuts this year.
Again, Ben Emmons of New Edge Wealth with us moments ago on Bloomberg Markets. The data this morning have assets in rally mode. We check the markets all day long on Bloomberg. Right now, the S&P 500 is up 26 points, or 0.6%. The Dow's up 97 points. That's a 0.25% gain. The NASDAQ Composite is up 97 points, or 0.7%. All the main industry groups, all 11 in the S&P, are in the green right now. So is the 10-year. It's up 11.30 seconds now. Look at that. Yield 3.95%. So coming down from 4. NYMEX crude's up 1.75% at $73.44 per barrel. COMEX gold is up about 0.9%, $2,068 per ounce. The euro 1.0989 against the dollar. The yen 143.99. Bitcoin down 1.6% below 44,000. That's a Bloomberg Business Flash. Bloomberg Markets continues. Paul Sweeney and Lisa Mateo.
All right, Nathan Hager, thank you so much. We appreciate it. Lisa Mateo and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live as well on YouTube. So head over to youtube.com, search Bloomberg Radio, and that's where you will find us. It is Jobs Day. Non-farm payrolls came in at 216,000. Solid number. The consensus was 175,000. Wages also continue to move higher on a year-over-year basis, up 4.1% versus consensus 3.9%. So pretty solid across the board here. Let's break these numbers down with Haley Dam, Vice President at Adecco. Haley, I mean, on the surface, these look pretty darn solid out there. What did you take away from today's labor data?
Thank you for having me. It's very encouraging to see the momentum that we saw coming through the end of 2023 move through the beginning of 2024. We honestly continue to be in an employee-driven market, but it's really nice to see that employers are rising to the occasion and are continuing their work around stabilizing and retaining the talent that they have as well.
Now, talk about some of the different sectors. I mean, we saw where the strength was. You see it in government, healthcare, leisure, hospitality. Are you seeing the same thing?
I don't deal as much in the government space as I do more in the entry level. We did see some lulls in that space, but that's very typical for this time of year, as well as the gains that we saw in the industries that we did. Every industry has their own level of seasonality or ebbs and flows, and it's very typical to what we expect. And we continue to see, or we expect to see, manufacturing and those, the ones that lost in January, to continue to go up through the first few months of the year as well.
So, Haley, where are we in terms of, I mean, labor availability? You know, for a long time, and maybe even still today, employers say they just can't find, attract, retain good talent. Is that still the case out there? And if so, why is that?
It is the case in some senses. There are a lot of available jobs, right? There are more jobs or more job seekers than there are jobs available. So it's interesting to think about what employers are doing to really attract and retain that talent. So it's a shift. Employers really need to do the work there to think about what sort of incentives they're bringing to the employee and how they're attracting that talent. We're starting to see that shift as the labor market continues to be tight. And it's interesting to see how these employers are reacting. Part of that truly is around sort of that wage and making sure that they're taking care of the people that they have today.
And what are you seeing as far as what the employers are looking for? Are they looking for skills? I remember we did a story not too long ago where they said college education not as important anymore. Is that changing?
I think the necessary skills for a job still remain the same. There are going to be certain industries where you do need that level of education and you do need to have certain certifications, of course. But really what employers are looking for is reliability, willingness to do the job, and willingness to stay with an employer, advance your skills, and really grow and learn with them so that you can be a long-term employee.
How about in older workers? I mean, are they coming back into the workforce? Is there demand for older workers? What's it look like there?
That's a very great question. So we obviously are seeing, they're calling it the peak 65, where we have a lot of a retiring workforce coming upon us this year more than ever. But, we've seen this for the past few years. It's very interesting to see how we can engage that type of workforce. And I think it really offers a lot of opportunity for employers. How can we use the workforce in a different way, maybe part-time, coming back into the workforce, mentoring, maybe less tenured employees? The knowledge and skills that they bring is so critical to continuing and maintaining business operations at the level that they have been. And employers are working to do that. So we are seeing a lot of retirees returning to the workforce, but flexibility is very, very important to them. They might not want to work 40 hours a week. We totally understand, right? So employers are having to get a little creative, but it's also presenting a lot of opportunities for those less tenured employees to take on expanded scope and maybe those promotional opportunities that they've been hoping for.
Now, Haley, speaking of that flexibility, I got to dig into the work from home thing. Here we go. So do you see that changing as we start to move into 2024? What's the deal?
Well, I think flexibility is always going to be a topic of conversation. Once we got a taste, we all want a little bit, right? So it's interesting to see how employers are responding. Many hybrid situations are happening. Every employer is doing it a little bit differently, but there is merit to being in that office and working together and collaborating. And we're seeing a lot of our customers and ourselves in general really working towards that, but also maintaining the idea or the mantra of that flexibility is very, very important to people. So you're going to see a little bit of everything in this space, and every employer is going to be different.
So how about I know you used to work at Darden Restaurants, staffing and training manager there. What's it like in the restaurant business these days? Because it seems like every restaurant has a help wanted sign there, whether it's, wait staff, busboys, front of the house, back of the house. Where is that industry right now?
Well, I'm not currently there, so I don't want to speak directly on that. But what I can say is when I was working there, it was still hard to find good talent in the industry. So I think it's a very difficult job, and it takes a very special person to be able to have those customer service skills. And it's going to be difficult to, continue to maintain that. But the good news is what we're seeing is a lot of people want to go out and they want to be about, so that the need is still there in that industry.
And how about wages? I mean, are we going to see competitive wages moving into this year?
I believe so. The wage pressure that we felt in the past maybe 12 to 18 months has certainly subsided a little bit, but wage is always going to be a topic of conversation. I believe it's interesting, or I believe that employers are going to take that and look at how they can continue to incentivize their current workforce. It's important to attract a talent, but it's even more important to retain the talent that you have today and reward the high performers that you have for doing the job that they're doing.
All right, good stuff. Haley Dam, thanks so much for joining us. Haley is a vice president at Adecco. Just giving us some thoughts and perspective on the labor market out there. Again, we got some stronger than expected data today, and then the JOLTS data earlier in the week showed there's still, well north of 8 million job openings. And that number, if you look over the last 10 years, is more like 4 million, 5 million average. So still well above. So a lot of people who left the workforce, I guess, during the pandemic haven't come back yet.
Yeah, and it's interesting. I'm always curious to see what this means for those kids who are coming into the workforce.
Yep.
Those college grads that are moving in, what this looks like for them.
Yeah, well, all my working eligible offspring are fully employed. So I'm doing my point. I got another one in college, but the other ones are all out there working and all fully engaged. So that's all you can ask, I guess.
You did your job,
I
Dad.
did my job, and they're off the dole, which is key.
Yes.
With a couple of Netflix issues to be resolved here and some things like that, but we'll work on that. S&P 500 up 0.6%. We're gonna have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, the world's most valuable electric vehicle maker, is taking a hit in one of its biggest markets. We get the story from Bloomberg's Joe Easton.
Tesla recalling 1.6 million vehicles in China, almost every vehicle that they've made over the past decade in the country, and this due to an issue with a Air software program that they use as part of their driver assistance autopilot that's got some issues at the moment, according to this report. And moreover, they are actually losing market share in China, which is the bigger issue. But again, negative news for them.
That was Bloomberg's Joe Easton reporting. Shares of Tesla are currently up less than 1%. Another bruise for Apple. More on that from Bloomberg's Joan Doniger.
One of its main suppliers, Foxconn Technology, says December revenue was down nearly 30% from November. Foxconn says weakness in computing and smart computer electronics products offset growth in cloud, components, and other things. Investors are already worried about weak demand for the iPhone, especially in China, where the economy has been weaker and the Chinese government is restricting use of foreign electronics.
Thanks, Joan. The latest setback comes after Apple stock was downgraded twice this week because of concerns about iPhone sales. And those red-hot weight loss drugs on the market, turns out they're doing more than shedding pounds. They're also thinning healthcare budgets. State and local governments are seeing eye-popping bills for drugs like Ozempic and Wegovy, with prices stretching above $1,000 a month per doses. Connecticut, for example, imposed new rules for state employees seeking weight loss treatments in July after spending on the drugs rose 50% annually. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets here, the S&P 500 up about 0.7%, the NASDAQ the same. The Russell up about 0.5% here. Yields come in. We've got the 10-year Treasury at 3.96. It was at 4.09% earlier today, so a big pull in on that ISM data, weaker than expected. WTI crude oil up 2%, $73.68. Gold, it's up a little bit here, $2,055 an ounce. Bitcoin, it is down 2.4%, 43,400 on the cryptocurrency. Right now, let's head down to Washington, D.C. We've got World and National News with
All right, thank you, Paul. The Biden administration is reportedly moving forward on keeping many of the former President Trump's controversial tariffs on some $300 billion in Chinese imports. Washington may also be increasing duties on electric vehicles and critical minerals. Axios reports President Biden wants to put his stamp on Trump's tariffs while showing a tough stance toward China. Next week will be a busy one in court for former President Trump. Bloomberg's Nancy Lyons reports.
Donald Trump has two major court hearings next week. One of them is in Washington on his claim of immunity from charges he overturned the 2020 election. That's set for January 9th. Then 2 days later, he's planning to attend the closing arguments in Manhattan. That's for the New York civil trial against him and his sprawling real estate company. Then a civil defamation case against Trump begins in New York, in which E. Jean Carroll is seeking $12 million in damages. It's unknown if Trump will be attending that trial. In Washington, Nancy Lyons, Bloomberg Radio.
17-year-olds in New Jersey will be allowed to vote in primary elections as long as they're 18 by the next general election. New Jersey will join 19 other states and the District of Columbia with similar laws on the books, although New Jersey's new law won't take effect until 2026. A winter weather system moving through the U.S. is expected to hit the East Coast this weekend with a mix of snow and freezing rain from the southern Appalachians to the Northeast. Bloomberg meteorologist Rob Carolyn with the timeline.
The storm system moving up from the lower Mississippi River Valley will be responsible for a mixture of rain and snow developing in the district in Baltimore tomorrow morning. That quickly goes to rain, but it stays as snow well inland. New York City, the precipitation is going to develop by late in the afternoon on Saturday. There we'll see a mixture of rain and snow along the coast, while inland is all snow. In Boston, it looks like a mixture of rain and snow developing along the coast late Saturday night.
Bloomberg meteorologist Rob Carolyn there. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Lisa.
All right, Amy Morris, I thank you so much. We appreciate it. Lisa, are you a gamer?
I am not, but my son is, yes.
Yeah, okay, I'm not either. It's not my demo, at least. But there's an interesting story in the Journal today. Netflix eyes ways to make money from video games and potential pivot. Netflix has said it plans to be in gaming for years to come. Now the company is trying to figure out how to make some money from it, a potential shift in strategy for the streamer. Executives at the streaming giant have had discussions in recent months about how to generate revenue from its games. And that's according to people familiar with the discussions. Netflix games are currently free for all subscribers, part of a strategy to keep users coming back to the streaming service when their favorite shows are between seasons, as well as to attract new fans. To be quite honest, I do use Netflix. I am a subscriber. I had no idea there were even games on there.
They do, and they're for free. That's why the people love them. But I mean, enough is enough. I mean, they cracked down on the password sharing, right? Now they're launching this ad tier service, so I have to pay more because my family doesn't want to watch the commercials.
Right.
And now they want to charge for these games. It's a tough thing.
It is. But, I mean, you know, some of the ideas that have been discussed include in-app purchases, charging for more sophisticated games it is developing, or giving subscribers to its newer ad-supported tier access to games with ads in them, the people said. So I guess if you're Netflix, you're just trying to figure out ways to generate more and more revenue off of your subscriber base, which you and I are subscribers, as is, I'm sure, pretty much everybody else around.
But they're pretty smart. They're basing a lot of these games off of their shows, so it kind of brings that whole thing back together. So that you have, you know, the game about the reality show, and it mixes it together, attracts more people.
Looking at Netflix stock here, it's up about a quarter of 1% today. It's got a market cap at $208 billion. Stock is up over 50% over the trailing 12 months. So whatever they're doing, the stock market certainly likes it. So we'll keep an eye on Netflix as we do. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to talk municipal bonds. Chris Brigatti, he's the Senior Vice President and Director of Strategic Planning at SWBC. We'll get his thoughts on this municipal bond market. Are there opportunities there? And then we're going to check in with Simone Foxman, reporter with Bloomberg News. She's going to join us to discuss her story on the burden weight loss drugs are having on state budgets, U.S. taxpayers, and the healthcare system. It seems to be one of the key stories in healthcare these days. And then we're going to continue with our healthcare discussion. Kristen Pothier, U.S. healthcare lead at KPMG, joins to discuss recent findings on the outlook for M&A in the healthcare sector. And I have always said, if I come back to this life again, I'm going to come back as a healthcare M&A banker. Those folks get paid every week, it seems like. All right, right now, let's kick this hour off. Nathan Hager can get a Bloomberg Business Flash.
Well, Paul, we're seeing some signs of life in the stock market, and a lot of investors might be thinking it's about time after the rough start to this year. We got weaker than expected services data from ISM, but stronger than expected data from the Labor Department in December payrolls. But even before the latest numbers on the economy, UBS senior U.S. equity strategist Nadia Lavelle said the risk for the full year when it comes to stocks, she sees it to the upside. And she says it comes down to the economy.
We think that the consumer remains in solid shape. Yes, you're seeing some areas of consumer stretch, but spending during the holiday season was pretty strong, and that should continue into 2024. Of course, it will be at a slower pace, but there aren't any signs that the broader consumer isn't holding in there, and inflation is coming down. You're seeing wage growth, so real income is picking up, and that should be a positive.
And you can hear more from Nadia Lavelle of UBS on the Bloomberg Surveillance podcast. We did see that pickup in the wage data in the non-farm payrolls report as well. We check markets all day long here on Bloomberg. Right now, the S&P 500 is up 31.7% higher. 4720 is the S&P level. The Dow Jones Industrial Average up 121 points, trading at 37,561. The NASDAQ Composite up 112 points, up 0.8% at 14,622. 10-year Treasury is up 6/32, yield 3.97%. 2 years at 4.32. NYMEX crude's up 2.1% at $73.73 per barrel. COMEX gold is up 0.6% at $2,062.40 per ounce. The euro is at 1.0977 against the dollar. The pound at 1.2749. The yen is at 144.24. Bitcoin is down 2.1%, trading around 43,500. That's a Bloomberg Business Flash. Bloomberg Markets continues now with Paul Sweeney and Lisa Mateo.
Nathan Hager, thank you so much for that. We appreciate it. Lisa Mateo, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live as well on YouTube, so you can head over to youtube.com and search Bloomberg Radio. Looking at the markets, as Nathan was just reporting, we got green pretty much across the screen. Good 0.7% gain in the S&P 500. Let's see where the action is under the hood. We check in with Bloomberg Equities reporter Nora Melinda. Nora, what are you looking at?
Well, good morning. I wanted to kick things off. It's 11 a.m. with beer and liquor. I'm
Nice.
taking a look
Never
at
too
Constellation Brands. I know, never too early, right?
Yep.
Constellation Brands, that's ticker STZ. It's up as much as 3.7% for its biggest gain since July. The firm reported better than expected beer sales in its latest earnings report. Its solid results for the beer business helped to offset a lackluster update on the wine and spirits segment. This company did also lower its fiscal year projections for wine and spirits. It did announce recently that the head of its wine and spirits business, Robert Hansen, will step down effective at the end of next month, and the CEO, Bill Newlands, will assume all responsibilities in the interim until they can find a new replacement. A Citi analyst did say that while another guidance cut in the wine and spirits department may disappoint, he believes that recently announced management change may be a positive catalyst for the company.
Well, this comes as dry January.
Right, in the mist.
Never heard of it.
We just had on the Bloomberg the story how sales of non-alcoholic spirits, they're set to grow at like 5 times
Right.
the rate of others. So it's funny how you're saying that, but yet we're seeing this switch where people are, especially Gen Z and the health conscious, they're making this switch, and now you have these new startups and you have big
what's
companies.
the White Claw thing? Anybody explain that to me? Are you into the White Claw? Can you explain what that
I
is?
do have a White Collar too. I mean, it's like a seltzer. It's an alcoholic seltzer, probably 5%, if not less.
See, but High Noon has less sugar.
Very true.
Yes. Yeah, I've seen that as well. Okay, but that's kind of what the kids are drinking these days.
But
When
I'm
you go
just-
to the beach bars down to Jersey Shore, that's what the kids are drinking.
Right, but I'm just interested, why are the beer sales up so much, but wine and spirits are down? I mean,
What
I
other
guess that's
beer
like-
brands at Constellation brands?
Maybe it's IPAs. Maybe
Yeah, I
IPAs.
don't know.
Maybe.
Well, I'm looking at the DES function for Constellation Brands because I don't know a lot about that company. They're based in Victor, New York. Where is Victor, New York, you ask? Southeast of Rochester. I mean,
There you
man,
go.
I couldn't have picked that out of it.
There you
Wow.
go.
Okay, very good.
Lovely for an 11 a.m. morning. But let's move over to Angiodynamics. That's ticker ANGO. That stock is plunging to a record low this morning and heading for its biggest drop since March. The medical therapeutic and diagnostic device manufacturer is slumping as much as 26% after the company revised its year forecast for net sales lower. The firm reported an adjusted loss per share for the second quarter of 5 cents versus a consensus estimate of 7 cents. And it did announce that it's shifting its manufacturing operations from a company-owned facility in upstate New York to a fully outsourced model over the next 2 years. So that does give investors something to look forward to, as this shift is expected to result in roughly $15 million in annualized expense reduction by 2027.
All right, good stuff. Anything else on my good friends at Peloton?
We love to talk about Peloton. Did we not have a great time about an hour ago?
Yes. still higher.
Yes, it's moving higher. Peloton is surging as much as 18% for its biggest gain since November. We all know that this is after the residual optimism that comes from its announcement that it's partnering with TikTok to create a fitness hub on the TikTok app. This should hopefully tap into a new pool of customers, and the agreement does mark the first time that Peloton will produce custom social content for a partner outside of its own network.
I mean, what I've told this company in the past is one of your greatest assets, which I think is undervalued by them and by the marketplace, is their subscriber base. We saw that in the cellular telephone business and the cable television business. Any subscriber business, you have to figure out ways to monetize your subscriber base. They have a ridiculously loyal subscriber base. You got to do something with them.
You being one of them.
Yes.
I'm just surprised they go to TikTok, though, because there's so much, owned by ByteDance.
Right.
The White House is not a fan. I mean, I'm surprised in a bit.
Scrunchul. They need to scrunchul, let's be honest.
Yeah.
They need some help. And stock, like I said, stock's up 14% today, but still down 18% year to date, and like a million miles away from where it was back in 2020. Nora Melinda, thanks so much for joining us. We appreciate it. Nora covers all the markets for Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. There is no greater friend to the municipal bond market than me. I tell every governor of the state of New Jersey, I'm probably the largest private creditor to the state of New Jersey through my municipal bond holdings. Chris Brigati, he thinks he knows a thing or two about it, but Senior Vice President, Director of Strategic Planning at SWBC. Hey, Chris, thanks so much for joining us here in studio. Fixed income actually had a positive year last year in terms of total return. How did the municipal bond market do?
The municipal bond market had a very good year, and it all really happened in the last 2 months of the year. It was negative coming into and through October, so the performance actually turned quite positive, about 6.4% to the positive by the end of the year, with over 7% returns coming in November and December.
All right, so what are we doing here with the municipal bond market in 2024? What's the call here?
The call is to be very strategic in terms of how you approach the market and allocate your capital. A lot of the investors that we're talking to and a lot of the people that we engage directly are really kind of being very cautious on their credit approach, not really going too far out on the credit curve, because those credit spreads narrow significantly in the rally through November and December. So now it's a matter of when can you re-engage the market in a more strategic manner, further out the curve or down the credit curve. And I think both of those opportunities could happen this year, but I do expect this to be another quite constructive year for the market in general.
So what else are we doing in the fixed income space here? Because 2022 was so brutal across the fixed income space. Double-digit declines like the fixed income market had never really seen. Had some positive results in 2023. Any reason for me to own bonds here in 2024?
I think there still are. You know, you look at the fact that we've got real good yields that we have not seen in well over a decade. So for a longer term perspective, you start looking at that. And, you know, if you're going to be clipping coupons and be able to grab that 4% yield if rates remained unchanged, barring the expectation for lower rate environment, which would add additional performance to a bond, if you can lock in 4% or better type of yields in this market, you're really looking at strong performance.
And Chris, dig a little bit deeper into what banks are doing with some of their muni teams.
Did Citi did they announce they're getting out of the municipal bond market?
They did.
You can't do that.
In
They're
December,
Citigroup.
it's amazing. They've made that announcement and backing out of the market. I mean, the market is becoming tougher and tougher. Spreads are narrower. It's becoming much more constrained. Regulators aren't helping. I'm not going to really kind of go down that path too deeply, but it's a challenging market for banks to make money in. And so the strategy and the way you approach it is how can you embed yourself deeper and better with clients to provide better service. And that's one of the goals that we're trying to produce at SWBC is how can we ingrain ourselves as a partner to those clients and really add value.
What does SWBC stand for?
Southwest Business Corp.
Southwest. Where are you guys based?
San Antonio, Texas is headquarters.
Nice. Is that where you're from?
No, I'm Northern New Jersey.
You're in Northern New Jersey. Okay, I'm a big fan of San Antonio. All right, so in the I don't know, where are we going to see a new issuance this year? I mean, am I going to see a bunch of new fixed income issuance, credit issuance, high yield municipal bonds? Am I going to see a bunch of issuance now that interest rates are coming down, do you think?
I think so. I think the opportunity for issuance to rise is twofold. One, you look at what happened with the taxable municipal market last year, which was down about 30% in terms of issuance. So I expect that to rebound a little bit. Last year issuance came in around $380 billion, which was a few percentage points lower than the previous year in 22. I expect this year to be a little bit north of 400.
And an average year is like 500-600?
No, an average year of late has been somewhere in that mid to low fours.
Mid to low fours.
Yeah,
okay.
yeah. So I expect to get more towards the average, and the opportunity for investors to engage that should be well stated.
But the municipal bond, like I've been told in the past that municipal bond issuers, municipalities, they don't issue money when rates are low per se. They issue money when they need it.
Correct.
So aren't we having a bunch of like infrastructure acts and things like that? Don't we have a bunch of stuff going from the federal government that needs to be funded in the municipal bond market?
There are. You know, it's funny. When the infrastructure bill came out several years ago, the market got all heady, and for lack of a better way of putting it, in terms of the opportunity for more issuance to come. But those infrastructure things take time to build. It takes years to get through the system, through the process at local or even larger municipalities to be able to construct that new road, to do something with a bridge. All those infrastructure projects take time to even get started. So once they get started, that's when the borrowing is going to happen. And I think that we kind of got through 2023 with the huge spike in yields we saw in October that scared a lot of people. Now that it's kind of more normalized, I think that the issuers are going to come back into the market. And they, like you said, they're going to come in when they have to. And when they don't have to and rates are high, they stay as far away as they can. So now the opportunity is going to be there, and I think they're going to come in quite strongly.
So who are buyers of municipal bonds these days? Like retail versus institutional. How does that split look today? And maybe how has that changed over the last decade or so?
Yeah, you know, that's one of the most interesting things, and that's one of the things we're trying to be aware of at SWBC is the retail investor has historically been a strong participant in the municipal market. Their participation has shifted less away from the funds. ETFs have kind of picked up some of the fund bandwidth and fund opportunity, but the small accounts that are managed by portfolio managers, so they're professionally managed, but it's an SMA. Those types of accounts are really where most of the opportunity is, and that has grown by more than double in the past several years. So those investors are really participating strongly and reaping the benefits. Tax-free yield, what's not to like?
Yeah, exactly. And so what's the credit quality in municipal space? I'm actually surprised. I mean, there's always the Puerto Rico issue or something out of Illinois or something like that. But other than some of those weird situations, I haven't heard of any cracks of note in the municipal bond market really for years.
It's been several years. You know, you look at the fact that the federal government allowed for some of the infrastructure bill, some of the opportunity for federal aid during the pandemic and COVID. So a lot of issuers have built up a reserve of funds as a result of that. So their credits are actually quite high, higher than they possibly would otherwise be. But generally, the municipal market is really, really solid footing. I mean, most of the investment and opportunity takes place in the triple B and higher investment grade. That's where the vast majority of issuance is. And the default rate on those is less than 1%. So the only time you hear about something like that is sketchier credits in odd, different markets. Healthcare is notoriously a challenge, some of the housing market as well, and then you get the odd issuers, and the Puerto Rico story always rears its head every
And then
once
there's
in a
the
while.
mall across the river there.
Exactly.
What's going on with that? What's it, the Dream Mall?
I think that's the name of it, yeah.
Yeah. So I mean, that is fascinating to me. I remember when that issue came to market, I said, I know nothing about the Dream Mall. I know nothing about the municipal bond market, but I wouldn't go near that bond issuance. I mean, I couldn't see how that thing would actually be successful, much less pay me back my principal.
Have you been there?
No, that's
Still
the
not?
point. That's the point.
Me neither.
I know.
You know, it's in a tough location for New Yorkers, especially. It's not an easier fun to go over the bridge and then travel through there. And you know, my kids have been there to go on some of the rides and do some of those things, and they enjoy it. But I haven't stepped foot in it myself either. And it's a tough credit, that's for sure.
All right, what are some of the sectors that you think are going to be interesting in 2024?
You know, I always mention things that are quality revenue bonds that I really like. And, you know, you go down the path of water and sewer bonds. Everyone has to pay their water bill. They need sewer. So I think in terms of higher credit quality, that's definitely on the plate. I think that offers opportunity. Other things that make sense are some of the better, higher quality education bonds, the well-known names, for lack of a better way of putting it. And then transportation revenue bonds, bigger airport revenue bonds, those sorts of things are going to be on the uptrend, I believe.
How about education? Because we've seen some stories about how if you're a small, mid-size, liberal arts college, that's a tough business. And I've seen some issuance. I've seen some issuance from secondary schools, prep schools, and things like that. I can't remember which the issuer was, but one of the top prep schools. How about those education-backed bonds? How do you think about those?
You know, to your point, it depends on the name and depends on the issuer and the credit. You really got to kind of understand and dig into the weeds a little bit to understand what is the underlying credit quality of each one. And to your point, you know, you stick to the higher names that are very well known, the place where it's Ivy Leagues, et cetera. You know, those names stand up very well. They have very strong participation. Their endowment programs are enormous. And when you look at their acceptance rates, they still have low acceptance percentages, meaning a lot of people still want to go there and very few still get in. You look down the curve and you start looking at some of the less well-known issuers, the liberal arts colleges that you mentioned, they're having a tougher time attracting and retaining people. And I think COVID was not helpful for that construct. They definitely suffered in terms of people wanting to go to college and or how they engage colleges directly.
So just real quick on Puerto Rico, are they out of the woods yet? I can't remember kind of where we are there. It's been so drawn out.
Yeah, they're not quite out of the woods yet. That story seems to be the story that never ends. So they're in challenging times. There's constant discussions over, you know, what's going to happen with the debt service and who's going to be paying it and who's responsible, and then what is the restructuring going to look like, and you know, that's getting into the weeds of it. Very challenging.
Yeah, stuff. Luckily, we have the Joe Mysak, who covers the municipal bond market for like a gajillion years at Bloomberg News, and he keeps us up to date on what's happening there. So we appreciate that. Chris Brigatti, thanks for joining us. Chris Brigatti is the Senior Vice President, Director of Strategic Planning at SWBC, based in San Antonio, Texas, also home formerly of Clear Channel Communications, my biggest client back in the day. USAA, great insurance company. Always stop in and say hello to those folks when I was doing my marketing down there in San Antonio. Looking at the S&P 500, we're up 0.6%. How about that? The NASDAQ up a little bit better to 0.7%. So some gains here, stabilization in the marketplace after a week. First couple of days of the year. We're going to have more coming up. This is Bloomberg. Let's get some company news with Steve Rappaport.
All shipping giant Maersk will continue to stay away from the Red Sea. That's because of the risk of attacks from Houthi rebels based in Yemen. More from Bloomberg's Alaric Nightingale.
The Houthis claim that they're going after ships with kind of an Israeli connection, and a lot of those reported links look increasingly tenuous. But some of these container shipping lines do have offices in Israel. If the Houthis are taking a really wide sort of interpretation of the ships they're trying to attack, then, you know, that might be enough to cause those companies to be wary.
Bloomberg's Alaric Nightingale reporting. Investors in Peloton might be feeling pumped thanks to its deal with a widely popular social media app. Bloomberg's Joe Easton reports.
They've done this pact with TikTok to put content on this social networking app, and that caused loads of excitement yesterday. The stock rose 14%. Analysts think that this could help them reach more people, get more Pelotons into people's houses, that kind of thing. But they're a little bit cautious on the fact that it will take a while for this to actually materialize into new customers.
Bloomberg's Joe Easton reporting the momentum of Peloton shares continues, now up 15% today. ESPN and NCAA have struck a deal to keep the majority of college championships on the networks for more than 8 years, or 8 more years. The new package also includes the women's basketball tournament, as well as baseball, softball, and women's gymnastics. The agreement is worth nearly $1 billion, but it will not include many of the marquee games from college's top sports, football and basketball. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 11:22 on Wall Street, I'm Nathan Hager. Stocks are on the rebound after a rough start to the year. Investors continue to digest data that hint the Federal Reserve could pull off a soft landing for the world's largest economy. In fact, we heard from Treasury Secretary Janet Yellen just this morning telling CNN that the U.S. has, in fact, achieved that soft landing. She says her hope is it will continue. Let's check these markets as we do all day long here on Bloomberg. Right now, the S&P 500 is up 23 points, or 0.5%. Dow Jones Industrial Average up 89 points, or about 1/4%. And the NASDAQ Composite is up 76 points. That is a gain of 0.5%. The 10-year Treasury is up 5/32, yield close to 3.98%. NYMEX crude is up 2.5% now, trading at $73.98 per barrel, close to 74 there. COMEX gold up 0.4% at $2,058.80 per ounce. The euro 1.0968 against the dollar. British pound 1.2741. The yen is at 144.31, so seeing a little bit more dollar weakness on the session. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Lisa Mateo.
All right, Nathan Hager, thank you so much. We appreciate it. Lisa Mateo is here with me. Paul Sweeney, we're live in our Bloomberg Interactive Broker Studio. All right, the two themes from 2021 from a stock market perspective for me that just came out of nowhere. One was AI, okay?
Of course.
And the other one was this weight loss stuff, the GLP-1s stuff.
Now, Ozempic, Wegovy.
I mean, you're a workout maven, so this is a non-issue for you. But for a lot of people, it's huge. I can see how this could just be massive, particularly if they get into a pill format. My question is always, who pays for it? Simone Foxman, reporter for Bloomberg News, TV, radio, and all that kind of stuff. She's everywhere. She did a lot of reporting on this. Has got a great story out on the Bloomberg terminal here. She joins us live here in our Bloomberg Interactive Broker Studio. Simone, help us figure out, because I think you can make an argument that almost, gajillions of people in the U.S., in theory, would want to take this drug, will want to take this drug, are taking this drug. But my question is, who pays for it? How does that all work?
Well, so there are different classes of people, right? You have your people who are insured,
Okay.
and their employers maybe pay for their health care, and some of them who are insured pay for it themselves. Then you have, people on Medicare, and then you have 85 million people, low-income people typically, on Medicaid. And this is the area that we really dive into, as well as some of those insured people. Because a lot of this burden is going to fall on states. States spend, on average, over a quarter of their overall state budget on healthcare costs. And those, for many states, including New York, are skyrocketing. And it turns out, this is going to be a larger and larger part of their budget as they try and pay for Medicaid costs, which is part of is a responsibility they have. They contribute to that, as well as their own state employees. Now, right now, most insurers, this is private, public, et cetera, pay for GLP-1s for people with type 2 diabetes. But the whole idea that we have been hearing from Wall Street is people who just are seeking this for weight loss, who are overweight, they're the ones that are ultimately going to be seeking this, and that's why this is such a massive market.
Yeah, the cosmetic weight loss.
Yes.
I mean,
exactly.
Eli Lilly, they came out yesterday and they warned about people doing it for this.
But it's not just cosmetic weight loss. It should be very noted that this has all these variety of health benefits. The 20% reduction that Novo Nordisk showed among patients who had a heart condition or some history of heart disease, as well as obesity. That's an enormous savings potentially for insurers, including public insurers, but at a cost of $1,000 a month for these drugs.
That's the number that jumped out at me from your reporting, $1,000 a month. And, a lot of these, government officials saying we don't have that money.
And the first government officials that we're really starting to hear from are the ones who control the state health plans. Again, not every state health plan covers this for weight loss. They almost all do for, subject to restrictions for type 2 diabetes. But the ones who do, including North Carolina and Connecticut, have both flagged that this is a real rising cost. And in North Carolina, this was a subject of very heated meeting over whether or not they should continue covering these drugs for weight loss at all. And ultimately, they decided anyone who was on it up till January 1st can stay on it for that reason. But people who are just seeking these for weight loss beyond this, specifically Wegovy, Saxenda.
You got some crazy numbers in here, just in terms of the Medicaid's growing GLP-1 bill. Here are the numbers. In 2020, $3.3 billion. In 2021, $5 billion. And in 2022, $7.9 billion. So that's just Medicaid.
And we have some limited data for 2023. I can tell you already the number is bigger.
Wow.
But here's the thing. You have to be on this drug forever. I mean, this is not a one-time thing, a couple months. No, you have to continue to be on this, correct?
Yeah. And the thing is, some of these costs, the costs that you just mentioned, Paul, a lot of these are driven by type 2 diabetes patients. In fact, I was going through these numbers. The biggest driver of that increase that you talk about between 2020 and 2022 is for a drug called Trulicity. This is a GLP-1 that has been out there, may cause some weight loss, but it's not the Ozempic, it's not the Wegovy, it's not the one with all this name recognition really for weight loss. So there's still a long way to go if we just are to cover all the type 2 diabetes patients. And we calculated in our analysis that bill, if all of the type 2 diabetes patients that actually deserve this, according to the research, were covered, that would be $41 billion for Medicaid alone. We can't even take in state health care plans there.
I mean, I'm not sure how to do the math, or I'm sure it's being done within the healthcare industry, but if more people are on these GLP-1 drugs, okay, that's an incremental cost, and can the system bear that? But you offset that by presumably some of the issues they won't have to deal with, obesity, diabetes, things like that. And that goes down to, I've even seen medical device company stocks sell off because there'll be less knee replacements, hip replacements, all that kind of thing. I'm not sure how to quantify that benefit versus what I know is the upfront cost.
This is an incredibly problematic analysis. We know that obesity itself is very expensive. Diabetes is $327 billion in medical costs a year. That's 1 out of every $4 spent. That said, like, don't bring into account the potential benefits of having people who are not spending their entire day on dialysis, who are contributing to the economy. That said, some of the early indications are, and the CBO has kind of done a little bit of thinking about this, is the cost is still too high,
And the supply is kind of being limited at this time. So what do you do? I mean, do you ration it out? What do you do at this point?
Yeah, the supply being limited means that the likes of Novo Nordisk have limited who these drugs go to first, essentially. And they're going to the diabetic patients first because it's more meaningful for them on a whole, on an aggregate basis, immediately. But, they're ramping up supply. The problem is the demand is just so huge. How do you ever bring down costs meaningfully enough to make it worth it? Now, it should be noted that some of these costs that we've talked about here are pre-rebate. So prescription costs for Medicaid essentially have due to manufacturer rebates, and these are the same. But these are the numbers we're kind of talking about. I think they give a good indication of how significant this is going to be.
Well, I'm a big fan of the state of North Carolina, not necessarily the University of North Carolina, being a Duke grad. But here, I noticed in your reporting here, the debate has played out most heatedly in North Carolina, where Novo Nordisk has 3 plants that make drugs for obesity and diabetes. Yet they're at the forefront of the state trying to limit what the state will pay for. So it's very ironic there.
And here, there's also this incredible calculus as well. So Dale Falwell, who we'll speak to later today on radio as well as on Bloomberg TV, he runs this plan, and apparently the prescription benefit manager, CVS, he says, told him that if they start restricting the population who can get drugs, Novo Nordisk will cut the rebates they get. So they'll have to pay much closer to $13.49, the list price of, Wegovy, the weight loss version of one of these drugs.
And that's $1,349.
Yes.
For a month.
Yes, versus the $772 that they were currently paying. So that makes the calculus even worse, right? So, essentially, if manufacturers threaten to cut these rebates because people are restricting that, it's this whole vicious cycle.
But, they're pushing it. Eli Lilly said it's going to launch this digital healthcare platform, and that's really going to push it. They're going to home deliver some of these medications. So they're pushing it.
And they're doing impact studies talking about the cost of obesity. That Eli Lilly has publicized a bunch of those or funded a bunch of those. They are lobbying state and federal officials. Mind you, Medicare is a federal thing, and there are some officials on Capitol Hill who are saying Medicare should cover this for Medicare beneficiaries just for weight loss too. Anytime you hear about this, it's expanding the potential population of people who could get these, and that doesn't even begin to take in the kind of marketing that we're seeing.
All right, great reporting here, Simone Foxman. With this story, and along with your co-reporter, Laura Namias. So Laura Namias, Simone Foxman, great reporting here, great story. Ozempic's mania's billions in bills are coming for U.S. taxpayers. Check it out on the Bloomberg terminal, Bloomberg.com. It's really good. It's got a lot of data that I have not seen before in terms of the cost and how the costs are broken down. What are the drugs that are in the marketplace? Who's in there? And where's the money going? And where's the money coming from? So great reporting, Simone. Thanks so much for joining us here in our Bloomberg Interactive Broker studio with our news in Washington, D.C., Amy Mars.
Thank you, Paul. The head of the Office of Management and Budget is not optimistic on a budget deal. OMB Director Shalonda Young at a breakfast in Washington, D.C., hosted by the Christian Science Monitor, said that she is typically an optimistic person, but she calls the task of writing spending bills before the January 20th shutdown deadline daunting. The chances of a January 20th shutdown are higher now because new Speaker Mike Johnson has vowed not to pass any more stopgap spending bills to buy some time. Now we're learning Speaker Johnson is considering direct talks with President Biden on Ukraine aid and border security. CBS's Margaret Brennan spoke with Johnson for this Sunday's edition of Face the Nation.
The Speaker of the House told me he does want a deal. He is open to considering what the Senate comes to, but he wants to make changes to it. But then he also said he wants President Biden to adopt unilaterally some policy decisions through executive authority.
CBS Face the Nation host Margaret Brennan on Bloomberg surveillance. Florida Governor Ron DeSantis and former UN Ambassador Nikki Haley held those back-to-back CNN town halls in Iowa last night, fighting to be primary GOP presidential challenger to Donald Trump, who has a huge lead in the polls. DeSantis called Haley a phony who is, quote, playing for voters who are not even core Republicans.
I'm the only one that has a chance to beat Trump and win the general election. Nikki Haley can't get conservative voters. She's the darling of the never-Trumpers.
While in New Hampshire, Nikki Haley said of the primary process, quote, Iowa starts it, New Hampshire corrects it. Well, she responded to criticism about that comment during the town hall in Iowa.
We're going to continue to be here. I mean, I've told people get used to this face, and I've been here over and over again. But if I didn't love Iowa, I wouldn't keep coming to Iowa.
While they did take jabs at each other, Haley and DeSantis also focused a lot of their attacks on frontrunner Donald Trump. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. I'm Nathan Hager. We check the markets all day long on Bloomberg, and stocks are on the rise. Bond yields are falling as investors digest data that suggests the Federal Reserve could be pulling off a soft landing. We heard from current Treasury Secretary Janet Yellen telling CNN the Fed's done it and pulled off the soft landing. But after the stronger than expected December payrolls data, former New York Fed president, now Bloomberg opinion columnist Bill Dudley said his former colleagues at the central bank, will be in no rush to cut interest rates.
So the last couple of weeks, there's been a sort of change of view that the Fed rate cuts might materialize a little bit more slowly with less force. And I think that this just reinforces that. The economy is still doing pretty well. Looks like we're going to have growth in the fourth quarter of 2% plus. Financial conditions have eased a lot over the last couple of months. So I think that risks are that the Fed's going to keep rates higher for longer.
And you can hear more from Bloomberg Opinion's Bill Dudley on the Bloomberg Surveillance podcast. S&P right now is up 0.4%, or 17 points. The Dow Jones Industrial Average, little changed, up 31 points. The NASDAQ Composite is up 64 points, a gain of 0.4%. 8 of the 11 main industry groups in the S&P are in the green, led highest by information technology and financials. Consumer staples is the biggest drag on the S&P right now, but not by much. 10-year Treasury is up 4/32, yield 3.98%. NYMEX crude is up 2.2% at $73.78 per barrel. COMEX gold up 0.4% at $2,057.80 per ounce. The euro stronger against the dollar right now, trading at 1.0968. Bitcoin down 2.2%, trading around 43,500. That's the Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Lisa Mateo.
All right, Nathan Hager, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney live with you here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. You know, I've said it before, I'll say it again. In my next life, I want to come back as a healthcare M&A banker. Those guys get paid every day. It seems like every Monday we come in and there's another mega healthcare deal. So let's see if that's going to continue here. Kristen Pothier, Principal, National and Global HCLS Deal Advisor and Strategy Leader. Kristen, we got to deal with that title there. We got to work on that. KPMG. I mean, if you, let's just say you're the global deal person. That's what I'm going to go with. At KPMG, they know what's going on out there in the world. So, Kristen, talk to us about the landscape for healthcare M&A. It just seems like it's almost like a way of doing business for this industry. If you can't come up with the drug or the therapeutic or whatever in your own R&D, you go out and buy it. Is that kind of where we are?
Absolutely. And when you look at healthcare and life sciences in general, it really is one of those recession-proof industries. People are getting sick. People get sick worldwide. They need better medication. They need faster medication. They need more access to therapeutics, diagnostics, devices. And regardless of whether we're in a major pandemic or whether we're in a major recession, we still have people that are getting sick. And so all of our groups in this space, whether they be healthcare firms, life sciences firms, they have to continue to innovate. And innovation in medicine is precision medicine. It is the future of medicine. It is generative AI. It is putting together a number of different types of pieces of the ecosystem so that we get to our patients faster. So you are absolutely right. Both inorganic and organic strategies are absolutely essential in this space. And that is what we have seen throughout the years, even as the deal market has softened over the past couple of years.
You know, I want to get more into that innovation that you were talking about. I hosted a panel for Bloomberg. It was about AI, and one of the companies there was healthcare, and they said AI is playing a big part. It is a game changer. So if you can get a little bit more into that for us.
Absolutely. And it's a game changer across all of the different subsectors of healthcare and life sciences. Remember, there are a number of different groups that are playing into this ecosystem. Our pharma companies need generative AI to really help take their rapidity of their pipelines, make everything going through the pipeline a lot faster, a lot more efficient, a lot more effective. Our health systems are using it both in the front office and the back office to take all of the patient data, all the patient claims, everything that they're getting hit with, and develop new patient journeys, new sample journeys for those patients to get them better and more effective therapeutics. And what I would say is that over the last year alone, the amount of time and energy and diligence that has been spent on generative AI, the companies, the partnerships, how we're even dealing with the space, has just gone snowballed throughout the industry. And so we're getting more and more questions on that every day. I would say that the amount of deal making, actual M&A in generative AI is less so than the partnerships and all of the questions around generative AI. But in 2024, we expect that to increase.
So what is precision medicine exactly, from your perspective?
Absolutely. Precision medicine is the best therapeutic or care for the best patient at the best time. And so when you think about that and you think about what I just said, it isn't a buzzword, it's the future of medicine. We want to be able to take one patient, look at that patient, and provide them the most effective and efficient care. And so that's what we see. And when we take that precision medicine out to precision healthcare, it adds in the entire ecosystem, whether it be the diagnostics that surround those therapeutics, whether it be the patient services, and whether it be in a domestic market or a worldwide market.
Now, talk to me about hospitals. They're facing these big financial pressures. You have workers, there's a shortage of workers. How is this going to change the industry moving into 2024?
Absolutely. Both generative AI and precision health happen to really help what you just mentioned. When you think about how many workers we have to put in the workforce, when you think about how many therapeutics that we need to save people's lives, if we can get more precise diagnostics, more precise services to our patients in a quicker amount of time in those health systems, that allows us to take our workforce and refine our workforce to only who we need. It also allows us to upskill our workforce, maybe with bringing in people that could be upskilled faster through generative AI approaches, and then allow us to manipulate and change our workforce to better suit the needs of what we need in the future.
All right, so from a deal perspective, Kristen, what sectors do you think are going to be most in play over the next 12 months?
When you look across healthcare and life sciences and you look at the lows of 2023 and you look at what's recovering quicker, each one of the subsectors in life sciences continues to be very exciting and for different reasons. Within biopharma, the innovation around cell and gene therapy, within a lot of our other biologics, within companion therapeutics, is continuing to move us through the pipeline and look at deals that are continuing to change the portfolio of each one of our pharmaceutical companies. When you look at diagnostics, we had a little bit of a lull last year, of course, as our diagnostics companies went into the new normal post-COVID, but now they are looking for interesting point of care, interesting innovations within diagnostics to help pharmaceutical companies and to help services in better ways. Devices are always going to be one of those areas where we keep on looking to say, is this the year? Device companies had a harder time during COVID, of course, as elective procedures really tanked. All those elective procedures, hips, knees, et cetera, all have come up again. And now as our health systems continue to promote those elective procedures, continue to bring them in, our device companies are looking very carefully at new innovative ways that they can bring new devices to the fold and emerge as the victors in that particular area. In healthcare, when you look at health systems, when you look at payers, and when you look at physician groups, we're seeing health IT and physician groups as being the most exciting areas, and continued consolidation and thoughts on health systems as the health systems continue to recover from COVID and really be very thoughtful about their costs, paired with the innovation that they're seeing from life sciences. Life sciences and healthcare are inexorably linked sectors. And so as we look at this overall, we're continuing to see the dynamics between innovation between those two teams.
Kristen, thanks so much for joining us. Really fascinating stuff there. Kristen Pothier, Principal, National and Global HCLS Deal Advisory and Strategy Leader for KPMG. Talking about kind of in the healthcare and life sciences sectors, deal activity there, and it seems like, again, a very, very active part of the market year in and year out. And the companies, it just seems like if they can't kind of build it in their own labs, they'll go out and acquire it, and that's a good strategy. We see that time and time again. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, the risk of attacks on the Red Sea is still too high for a giant shipping company to set sail again. We get more on that from Bloomberg's Jeff Bellinger.
Steve, Maersk does not expect to resume shipping on the Red Sea anytime soon. The company paused transits in the region earlier this week, saying it would assess the situation. The evaluation by Maersk determined there is still a significant security risk to ships, and the company says it will continue diverting ships away from the Red Sea for the foreseeable future. That means vessels that normally use the Red Sea will sail around the Cape of Good Hope. Shipments will be delayed, but there is more assurance they'll arrive. Steve?
Thanks, Jeff. OpenAI is planning its own online store with a launch coming next week. Let's get more on that from Bloomberg's Joan Doniger.
It would let you share custom versions of the company's GPT chatbot, so you could be able to do that without having to learn coding. The store would allow the company to make money, like it would with apps in Apple's App Store. The company made the announcement in an email sent to some users.
Joan, OpenAI planned to introduce the store in November, but delayed the launch, citing the interruption caused by the ouster and reinstatement of CEO Sam Altman. Global supermarket chain Carrefour will stop selling Pepsi products in its stores in France, Belgium, and Spain and Italy because of price increases over popular items like Lay's potato chips, Quaker Oats, Lipton tea, and, of course, the namesake soda. That comes as a French law meant to fight the rising cost of living has supermarkets facing millions of dollars in fines if they don't reach a deal with suppliers on prices by the end of the month. And those are the company news stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, still holding on to some gains here in the market. The S&P 500 is up about 0.4%. The Dow Jones is pretty much unchanged here. The Nasdaq's up 0.4 as well. Yields coming in slightly. 10-year Treasury. I take that back. The 10-year Treasury is kind of steady right here, right at 4%. We'll call it. WTI crude oil up 2.3%, just under $74 a barrel for WTI crude. Gold pretty much unchanged here. Let's call it $2,045 an ounce. And Bitcoin, it is off 2.6%, 43,300 for the crypto. Tom Keene's not here, so we'll quote Bitcoin. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Marrs.
All right, thank you, Paul. President Biden will kick off his 2024 pitch to voters today, the day before the anniversary of the violent riot at the U.S. Capitol on January 6, 2021. He'll speak from near Valley Forge, Pennsylvania, and he had planned to give this speech tomorrow, but the winter weather forecast forced the White House to shift it to a day earlier. Biden will pose the question of whether democracy is still a sacred cause worthy of sacrifice and will characterize a second Trump term as a serious threat to democracy. The president is scheduled to make his remarks around 3:15 this afternoon, Wall Street time. And that winter weather system, that's moving through the U.S. and is expected to hit the East Coast this weekend with a mix of snow and freezing rain from the southern Appalachians to the northeast. Details from Bloomberg meteorologist Rob Carolyn.
Storm system moving up from the lower Mississippi River Valley will be responsible for a mixture of rain and snow developing in the district in Baltimore tomorrow morning. That quickly goes to rain, but it stays as snow well inland. New York City, the precipitation is going to develop by late in the afternoon on Saturday. There we'll see a mixture of rain and snow along the coast, while inland is all snow. In Boston, it looks like a mixture of rain and snow developing along the coast late Saturday night. It'll be all snow inland.
Bloomberg meteorologist Rob Carolyn tells us it should be all gone by Sunday night into Monday morning. Actor David Soul, who earned fame as the blonde half of crime-fighting duo Starsky and Hutch in the popular 1970s television series, has died after what his wife called a valiant battle for life. Soul portrayed Detective Ken Hutchinson on the show that ran from 1975 through 79, and you might also find some of his music from the 70s.
Don't give up on us, baby. Don't make that wrong.
Soul hit the charts with the single Don't Give Up on Us. David Soul was 80 years old. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Lisa.
All right, Amy Marrs, thank you so much. We appreciate it. Still some challenging shipping issues in the Red Sea for the global shippers. In fact, Bloomberg's reporting today, AP Moller Maersk plans to continue diverting ships away from the Red Sea, quote, for the foreseeable future, after pausing transits earlier this week to assess the situation. Its latest decision marks a subtle but important adjustment from what the Danish company was saying previously. And on January 2nd, the shipping giant said it would avoid the area until further notice after another of its carriers had come under attack in the space of a few weeks. The pause then was intended to allow time to further assess and the constantly evolving situation. All of Immerse vessels that had been due to transit the area will now sail south around the Cape of Good Hope. And I have to admit, Lisa, my geography in that part of the world was bad. So when I popped it up on Map Go on the Bloomberg terminal, that is
it's a huge detour.
Huge detour. This is not just, going around the block. This is 10 to 12 days to sail if you're coming, when you're bypassing the Suez Canal and the Red Sea. No wonder they built the Suez Canal. Good strategy there. But boy, that's a big diversion in the time and the cost associated with it.
And it's funny, and you hear about this, but then you also hear about, the big naval response from all the Western countries. You think that would, help a little bit, make them ease off some of their what they're worried about. But in this case, I guess not. It's not looking like that.
Exactly. And the further reporting from Bloomberg, the Red Sea is a vital trade corridor that cuts transport times between Asia and Europe. And Maersk ships are a large part of a network of vessels that form the backbone of global trade. The shipping giant's plan to shun the Red Sea indicates that it doesn't view the naval response from Western countries as sufficient to secure the area. 2 Maersk ships have come under attack since mid-October. So some great reporting from Bloomberg News. We'll stay on top of this story. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries? Soft landing, hard landing, no landing? I don't know. True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to spend a lot of time talking about the labor market. We got some important jobs data today. We're going to break that down to the number of smart people. Julia Pollack, chief economist at ZipRecruiter. That's how the kids get the jobs these days. Tom Gimbel, CEO, LaSalle Network, one of the largest staffing companies in the country. He's going to join us as well. So we're going to break this down, see where we go from here for the labor market. But first, we'll kick this hour off with Mr. Charlie Pollack.
Hi, thank you very much. And here's what's going on. Green on the screen with the Dow, the S&P, NASDAQ all advancing. The Dow now up barely, up 7 points. Little change there, up by less than 0.1%. S&P on track for a losing week, up 15 points right now, higher by 0.3%. And we have got the NASDAQ Composite Index up 58, gain now of just about 0.4%. We do have stocks moving higher today. However, it is shaping up to be the S&P's worst week since late October. 10-year yield 4.00% with a 2-year 4.35%. Spot gold little changed, up now by just about 25 cents the ounce to 2,044, while West Texas Intermediate crude is advancing another 2.3%, 73.87 a barrel. Bitcoin today is lower. Bitcoin right now down 2.3%, 43,357 on Bitcoin. Jobs Friday, job growth gathered strength in December, advancing by 216,000. Wages also increased. Unemployment held steady at 3.7%. Reaction to the jobs report from economist Tiffany Wilding at PIMCO, who was interviewed this morning on surveillance.
Today's report was a pretty solid report. 216,000 payrolls per month, and I think we're kind of close to that in terms of the average for this year. I mean, that's a very good outcome for the U.S. economy.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Bank earnings will begin fast and furious 1 week from today. That'll be the conversation next week when we hear from J.P. Morgan Chase, Citigroup, Wells Fargo, and Bank of America. Bank stocks, they're higher today. J.P. Morgan Chase up 0.7%. Citigroup up 1.4%. Wells Fargo up 2%. Bank of America now up by 2.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, good stuff there. Lisa Mateo, the Lisa Mateo, sitting in for some guy, I don't know, can't remember what his name was, who used to be my co-host. Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio. We're streaming on YouTube, so head over to youtube.com and search Bloomberg Radio. As Charlie was just reporting, a little bit of green on the screen, nothing to write home about, but let's call it a stable day after some selling pressure on the first couple trading days of the year. Let's see where the action is in the markets. We check in with Nora Melinda. She covers all the markets for Bloomberg News. Nora, what are you looking at?
Kicking things off with Agilon Health, that's ticker AGL. It's down as much as 37% today, tumbling to its lowest level and biggest plunge on record. The company, which is focused on transforming healthcare for seniors, trimmed its adjusted EBITDA outlook for the full year, citing higher than expected costs. It also provided weaker than expected profit guidance for 2024. As a result, we had a JP Morgan analyst downgrade the stock to neutral, further spurring its plunge today. The analyst said, "We believe the consistent underestimation of medical costs in a rising utilization environment highlights the significant risks Agilon faces." The company also announced that its CFO, Timothy Binsley, will retire and said a search for a new CFO has been initiated.
Never like to see the CFO leave.
We don't love that. We don't love that.
We were just talking about the healthcare industry with KPMG. And we see all the struggles that they're going through. So this,
I mean, is Agilon just one of these things, or Agilon, is it just a drug hits or it doesn't hit? Is that kind of where we are with this one?
I mean,
outlook misses. So, it's just one of these things. Like, I figure in the hedge fund business, if you really want to make huge alpha here, you do the biotech stocks. Because those things are binary. They either hit and this thing double or triples, or you miss and it goes to zip. So But that's the tough game right there in the healthcare space.
Exactly. Also, staying a little bit in the healthcare realm, but moving over to real estate, looking at Medical Properties Trust, that's ticker MPW, and it's down as much as 32%, plunging for its biggest drop on record and lowest level since March of 2009. It's a healthcare REIT that we spoke a little bit about earlier that specializes in inpatient rehab centers. The shares are plunging after the firm said it plans to accelerate its efforts to recover uncollected rents and outstanding loan obligations from Steward Healthcare System. We have a story that went out on that earlier this morning. The company has said it has taken steps to recover some of those uncollected rents, but it has provided some funding toward that. So it's making investors very worried.
Ooh, so one tenant can have that much
power. I mean,
wow.
total
That's
unpaid
risk.
rent is $50 million as of December of 2023. So
Medical Properties Trust, Birmingham, Alabama. Yeah, it's got about a $2 billion market cap.
Definitely.
And anything else for us?
Yes. Second biggest decliner by percentage in the S&P 500, we've got Huntington Ingalls Industries. Looking at two defense names, Huntington and Booz Allen Hamilton, Barclays downgraded both of those defense names on valuation, Huntington to equal weight and Booz Allen to underweight. Barclays said that Huntington outperformed in 2023, but the analyst expects it to grow less than its peers this year. Huntington shares are down as much as 2.4% for their biggest drops in September, while Booz Allen shares are down as much as 1.4%.
Huntington, they make submarines. I mean, these are some serious manufacturing. They design, build, and maintain nuclear and non-nuclear submarines and other ships based down in Newport News, Virginia, down there in Norfolk area. So that's, I would think that, I mean, don't we always need submarines? I don't know how that works.
VA.
All right, very good. Stocks down. Yeah, that's down 2.4%, up about 13% over the trailing 12 months. Very good, Norma Linda. Thanks so much for joining us there. I've never been on a submarine. I'd love to go on a submarine, but I guess you'd have to join the United States Navy to do that.
Or you go down to the Intrepid. That's what I did.
Yeah, that's exactly. I've been onto the Intrepid.
Field trip.
Go in the submarine one.
Oh, I didn't do that.
Yes.
Oh, okay. All
Lisa,
right.
you got to take me.
I'm claustrophobic. It was not a very fun time.
Yeah, so anyway, some very good stuff. Norma Linda, thanks so much for joining us. She covers all the markets for us. Yeah, I'd love to do that, but boy, and those people, that is tough duty. You go away, you're locked into this tube for like 6 months in a row, and then you come back. I mean, that's just, God bless the people on
and
the
the smells
men and women
that go through that submarine must be
Exactly.
amazing.
So we give great thanks to our
Yes.
U.S. Navy folks that do that for us. Let's talk about this jobs market. Again, it is resilient. It is robust. I don't know what it doesn't matter. It just seems like you can't crack this labor market. There continues to be some pretty solid demand. Julia Pollack joins us. She's a chief economist at ZipRecruiter. So, Julia, we got some better than I think expected jobs data today in terms of the number of jobs and then also the wages. What are you seeing out there at ZipRecruiter when you look out there at the labor market? Somebody push a button. All right. There we go. We were muted. Are we still muted? Yep, I think there we go.
would have mastered that. Yeah, the unmute button should be everyone's expertise now. It was a mixed jobs report, but yes, zooming out, 2023 was a remarkable year in the labor market. We not just dodged a recession, we completely avoided a recession in the labor market, even though it did slow substantially. And not only that, it was actually one of the best years on record when it comes to the unemployment rate, the average unemployment rate. It ties for 5th place since 1968.
Wow.
So pretty strong year overall.
And talk about some of the trends that are going on. We used to talk about that trend of job switching. Is that still safe, or is it best to just stay in place?
So the data that came out earlier in the week, the JOLTS data, showed a pretty substantial decline in job switching. So the quits rate fell to the lowest rate since early 2018. And that suggests that the Great Resignation is completely over. And the hires rate also plunged to the lowest level since 2014. And so the reason that overall employment levels are going up is not because of aggressive hiring, it's more because of very slow turnover and churn. And what we're seeing at ZipRecruiter is a continued gradual, orderly cooling in the labor market that's likely to persist until the Fed takes its foot off the brake pedal and allows the economy to, invest and boom again.
So, Julia, what is, I guess, employee hoarding? Is it a thing? Is it real?
So if you look at layoffs and firings, they have been about 20% lower this year than was normal between 2016 and 2019. Okay? So we're seeing historically unusually low firing and layoffs at a time when there are many industries where activity has taken a huge knock from high interest rates. If you look at the construction sector, it's actually up over 400,000 jobs since before the pandemic. Industries like banking, where I think if you look at a lot of the numbers, it hasn't been so great, right? Lots and lots of bank deposits have left that system, like $870 billion. Bank stocks have fallen pretty substantially and underperformed the S&P 500 by the largest amount ever. And yet, overall employment in that sector has been flat as a pancake. So yes, I think there is a sign that employers are holding on to the workers they've got, even in industries that are pretty slow, because they are confident that things are going to turn around soon.
Well, and when you talk about that, managing this headcount, so is it that they're relying on attrition or rather than doing layoffs? What do you see?
Yes, but even overall headcount numbers are staying pretty flat and stable. One exception is transportation and warehousing, where we are seeing some sort of right sizing in that sector now after it posted the largest gains since the pandemic. So, as people get back to normal and spend more on services and goods spending slows, or growth in goods spending slows, that industry is shedding jobs. But most are not. Employment is pretty stable and flat and resilient. That said, the only sectors that are really contributing to growth at the moment are these three largely acyclical sectors: the government, healthcare, and leisure and hospitality. They accounted for 92% of all jobs added in the last 6 months.
So, Julia, people are at work. My question is, where are they working? Are they working at home? Are they working in the office? Where are we on that these days?
So it's a very, very mixed bag. Remote work has pretty much stabilized now at around 25 to 28% of all worked days, up from about 5% before the pandemic. And this is the year when that really stabilized. Many companies brought workers back to the office, but many other companies started afresh in a remote first posture. And among companies, sort of flexibility became the norm. The 5-day in-office work week became very rare. Only 16% of companies with office jobs.
So I'm one of the special people then.
5 days. You're one of the special unicorns.
I knew I was special. See,
most people get at least 1, 2, 3, or 4 days off.
So I hear
out of the office a week.
And we heard a lot of stories in 2023 about the Great Resignation. Is that gone in the days of 2024?
It's gone. Turnover is not just back to pre-pandemic normal. It's actually lower. It's about where it was in early 2018. And that is a really reliable measure of how much economic opportunity there really is for unemployed workers, for workers to find better jobs. And I think it suggests that there is some cooling in this labor market, and that workers are finding it a little bit harder to find new jobs and to find the kinds of jobs that they want right now.
All right, I guess, employment-ready offspring, they're all employed. But how about folks coming out of college and graduate school? How's that entry market right now?
So surveys of employers suggest that they are projecting hiring fewer members of the graduating class of 2024 than of previous classes. That said, those projections can change. It's quite possible that 2024 could be like 2023 again, in that companies start the year expecting to cut headcount and cut costs more aggressively, and then realize, wait a second, there's no recession on hand, the consumer's still strong, I need workers, and actually hire more than they're expecting at the start of the year, especially if we see interest rates come down and investment rise.
Connection lost. And New Year, people out there looking for a new job. Do you have to rip up the script when it comes to your resume? I mean, if you want to start all over again, what should you do differently when you're putting it together? Is it more about skills? What should you have on there that really stands out?
Yeah, so this is not a chronology. It's more like an advertising pamphlet showing your greatest hits, your most relevant skills and experience. That's, I think, how people should think about their resumes. Put the relevant experience up first, and then it's really important these days to have a digital job seeker profile. So upload your resume, make sure it can be read by computers and parsed by these job marketplaces so that you're actually getting your foot through the door and getting past the robots into a human.
How about in the trades? People tell me that there's still a shortage of tradesmen and women out there. How does that part of the market look to you?
Yes, so there are many industries with aging workforces, with a lot of retirements, and with shrinking pipelines of new talent. New, younger generations of workers are not as interested in those roles. They also are seeing a labor force with a lot more flexible opportunities, and so they're going to the remote jobs and the tech jobs and the influencer jobs. There's tremendous interest still in marketing roles and PR roles and those kinds of things, and much less interest in doing hard labor in manufacturing or construction. That said, wages in those fields are rising in order to deal with the supply shortage, and perhaps you'll see a tipping point where people start to take more interest in these roles.
And what about the gig sector? I've heard a lot of talk about there's more freelancers out there. That's what people are looking to do more. Is that still growing into 2024, or is that cut back, you think, this year, a little cut back?
So unfortunately, official data on gig work is not very good, and we haven't really been tracking it over time in a consistent way. So it's kind of a bit of a black box. It's hard to know. We can look at the company's earnings statements about how many users they have. Look, broadly, we do see a lot of interest among job seekers on ZipRecruiter in those kinds of gig roles because of the flexibility they offer. There are many young people who sort of live from hand to mouth and have fun and watch video games and do what they want to do. And if they need cash and need to buy groceries, need to buy dinner, they, log on to an app and deliver groceries for a couple of hours and then buy their own and then go back to doing what they were doing. That it is quite common to work that way these days. That said, there's some new research showing that once AI tools, ChatGPT was launched, generative AI, demand for other kinds of freelancers started to fall.
Right.
So
interesting.
Yeah,
all right, we'll keep an eye on that.
White collar freelancer.
Yeah, you just walk across or walk through any local coffee shop, and I'm like, what are these people doing here? But they all got their laptops out, and they look like they're doing something, creating value. I don't know. Julia Pollack, she's the chief economist for ZipRecruiter, giving us the latest from her perspective at ZipRecruiter, kind of where the labor market is, where the opportunities are. That's a New York Stock Exchange listed company. ZIP is the ticker. Let's get some company news right now with Steve Rappaport.
Paul, the world's most valuable EV maker, is taking a hit in one of its biggest markets. We get the story from Bloomberg's Joe Easton.
Tesla recalling 1.6 million vehicles in China, almost every vehicle that they've made over the past decade in the country, and this due to an issue with a Air software program that they use as part of their driver assistance autopilot that's got some issues at the moment, according to this report. And moreover, they are actually losing market share in China, which is the bigger issue. But again, negative news for them.
That was Bloomberg's Joe Easton reporting. Right now, shares of Tesla down less than 0.5%. It's another bruise for Apple. More on that from Bloomberg's Joan Doniger.
One of its main suppliers, Foxconn Technology, says December revenue was down nearly 30% from November. Foxconn says weakness in computing and smart computer electronics products offset growth in cloud, components, and other things. Investors are already worried about weak demand for the iPhone, especially in China, where the economy has been weaker and the Chinese government is restricting use of foreign electronics.
Thanks, Joan. The latest setback comes after Apple stock was downgraded twice this week because of concerns about iPhone sales. We've heard of a lot of side effects about Ozempic and Wegovy, those red-hot weight loss drugs that are dominating the market, but it turns out suicidal ideations likely isn't one of them. Semaglutide, the active ingredient in Ozempic and Wegovy, has failed to show an increase in those ideations. That's according to a study funded by the National Institutes of Health. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Big drop for the Dow since our last update. Worst level of the day right now. We have got the Dow Jones Industrial Average trading lower by 63 points. That is a gain of 0.2%. S&P 500 index on track for a losing week, holding on to a 6-point gain right now, up by about 0.1%. NASDAQ, the composite index, up 25 points now, a gain of 0.2%. NASDAQ 100 up 34, higher by about 0.2%. 10-year yield 4.01% with a 2-year 4.36%. Spot gold up 79 cents the ounce, little change at $2,044, while West Texas Intermediate crude up 2.4%, $73.91 a barrel. Jobs Friday, job growth gathered strength in December, advancing by 216,000. Wages also increased. Unemployment held steady at 3.7%. Reaction to this morning's jobs report from Julia Pollack, chief economist at ZipRecruiter, interviewed moments ago right here on Bloomberg Markets.
It was a mixed jobs report, but yes, zooming out, 2023 was a remarkable year in the labor market. We not just dodged a recession, we completely avoided a recession in the labor market, even though it did slow substantially.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Apple off to its weakest start to a year since 2019, down again today, putting its long-standing status as the world's most valuable stock by market value in jeopardy. Right now, we have got Apple lower by 0.1%. Again, the Dow retreating 64 points, a drop of 0.2%. S&P up 0.1%. 10-year yield 4.01%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pelleton, thank you so much. We appreciate it. Lisa Mateo, Paul Sweeney, live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube. That is the internet, Lisa. YouTube.com. Search Global Radio, Bloomberg Global Radio, and that's where you'll find it. Jobs Day. That means, who we've got to talk to. Tom Gimbel, founder and CEO of LaSalle Network. LaSalle Network's one of the biggest staffing and recruiting companies in the country. If anybody's got the finger on the pulse of what's going on out there in the labor market, it's Tom Gimbel. Tom, any way you slice it, looked like some pretty solid numbers today.
It doesn't suck, that's for sure.
There you go.
I think, if you want to take a negative angle, you can say that over 50,000 jobs were government related.
Okay.
And that's fine. But if you say that, then 160,000 is the jobs report for the private sector, and that doesn't suck either. So I agree with you. I think this is a good sign. I think it shows that the government is still leading the way, so to speak, which it's hard not to anticipate that during an election year. We'll see what continues to happen with the stock market, but I don't think we're going to have interest rates dropping for quite a while.
Oh, Tom, I like you. This is Lisa here. I'm loving you. I got to say, you had this blog post on your website. You talked about the role of generative AI, not replacing jobs, but kind of freeing up those workers to do those more fulfilling tasks. How are companies going to have to adjust to this? Do they have to do more training in order for this to work out?
I think there's twofold. I think number one, companies never do. Companies think they do a lot of training. They don't do nearly enough, and that's for anything. So yes, I do believe that companies need to do that. However, what we're seeing, and I think a lot of companies don't realize, Lisa, that how many employees are already using AI for their jobs, and we're going to shift from employees using AI intrinsically to do their jobs better and to find answers and solve problems to companies strategically using AI to do jobs. And there's a fine line for that. And I think what we have right now, and I think we'll probably have it for this year, is more employees using it to be more efficient and get their jobs done faster versus most companies strategically using it to reduce wages and headcount.
Tom, one of the big issues in this country, it just seems to be amplified over the last several years, is illegal immigration. It seems to be the top of the news every day. Where are you seeing it? How are you seeing those people kind of in the jobs data, in kind of your day-to-day work at LaSalle Network?
I think that that's a big challenge and a big problem that we have here is how you track the illegal immigration and what they're doing for workers. So we're not seeing people who are working at the golf course or in the restaurants that are illegal doing that and coming from south of the border, and that's that I come from a little bit of a unique thing, and a good thing I'm not a politician right now when I say this, but you need some illegal aliens who are doing those jobs because Americans don't want them. And until we figure out legal immigration, we've got some real challenges. Now, we don't need the hundreds of thousands of people that are coming in monthly that are causing all the problems. I get that. But the work needs to be done. And until the American public wants to put on their apron and go wash dishes or work the golf course or do those jobs, we need those folks. And it's not showing up in the data. And we're still short. We're still short a lot in the service industry for those types of jobs.
Now, Tom, there was a time that we saw the job seekers, they had the upper hand. Are employers in the driver's seat now? Who's running the show?
Yeah, it's definitely back to the employers. I think, actually, as I say that, I think we're kind of at almost an even playing field where unemployment remains low, as we saw in the jobs report of under 4% at 3.7, but we still saw a slight uptick at 0.4% of wages, which isn't helping anything with inflation, but I don't think the layman understands that quite yet. And so we have really an equal playing ground, but it's definitely not 2021 where the employees were hugely in the driver's seat and demanding all sorts of concessions in addition to higher wages, that employers are now, number one, they're not offering huge increases to come over, and they're definitely not doing huge counters to keep people. And simultaneously, we see that the remote work and let me do whatever I want whenever I want from the employee isn't being accepted anymore.
Hey, Tom, manufacturing, it's about 30% of the U.S. economy, but it's been in recession for quite some time here. What are you seeing in terms of the labor market in the U.S. manufacturing sector?
Yeah, I'm bullish on it, actually. I think what we lost a little bit of it was in 2020 and 2021, there was a huge belief, present company included, that made in the USA would mean something versus China after the COVID outbreak and what have you. And I don't think that came to fruition as fast or in a way that we all thought. What I do think is going to drive it is the auto industry, heavy machinery, and consumer packaged goods. And I think that when we see that more and more of the candy and the food and the equipment getting made here, like the chips being processed in Ohio and things like that, I think we're in a better place. But I think you got to remember, people want to see manufacturing jobs increase tomorrow, and it takes a long time to build factories, to get the machinery that's going to go into the warehouses and into the factories to make it, which is also, those are manufacturing jobs as well, but it's not at the same volume. I think we're going to see a huge manufacturing boom in this country in 2025, 2026, and so on.
Tom, I want to talk diversity, equity, inclusion. You had the Supreme Court, they struck down affirmative action in colleges. Where companies look to for those workers. Do you see that still continuing as an important role into 2024?
I think diversity and inclusion is hugely important. And what I think is got in the way was sensitivity. And I think that it was, you can want to make your workforce more diverse and more inclusive and not have everybody be sensitive about every mistake and every word that comes out of somebody's mouth. And I think what happened over the past 3 years, combined with people being isolated and then being in the driver's seat, so to speak, like we were talking about, and wanting to tell the employer how to be, right? We have a percentage of the country that's a union, but we're not a union country. And I think that we've got to look at this a little bit more holistically, is that as a society, in a corporate America, we need to be more inclusive. We need to have more diversity. Check. What we don't need to do is punish people for making mistakes. We don't need to punish people for unconscious insensitivity. What we need to do is coach and teach. And just because you're in a class that is classified as diverse or hasn't been as inclusive doesn't mean that you get to set the rules. It just means you need to have an even playing field. And I think we're moving more back to that world.
Tom, Lisa and I, we are the outliers. We come to the office 5 days a week. What's the world? How's it shaking out there with that?
My guess is a year from now, we're going to be talking about looks like everybody's 4 days a week. I think we're going to be Monday through Thursday. I think Friday is going to be what casual Friday was for the last 30 years. And it'll be remote Friday. But everybody will be in the office Monday through Thursday, except for a few companies that it's in their business model to be remote, which I got a news flash for everybody. It was that way before the pandemic for a certain amount of companies, and everybody didn't jump on board. I think we're going to be Monday through Thursday. And, I've been over to Bloomberg. I mean, you got all that food in the lobby and stuff.
Exactly.
We don't want to come there.
Exactly. But anyway, here with us, Bloomberg Radio and TV, we're here every day. So that's okay, though. Tom Gimble, founder and CEO of LaSalle Network, giving us his thoughts, his unique thoughts, as he always does on these jobs days. Again, LaSalle Network, one of the leading staffing companies out there. So Tom and his company really have their finger on the pulse of kind of who's hiring, who's not, and where the opportunities are.
He's a great guy.
Yeah,
He shoots right out there.
straight shooter. So, but interesting. I think it really does feel like that's kind of the new norm here for a lot of companies, 3 to 4 days a week. But it's interesting just watching the traffic. Some days here you have to wait for an elevator. Fridays, just walk right in.
Yeah, Mondays and Fridays. It's a ghost town sometimes.
Yeah, it's interesting. That's the new norm. So we'll see how that plays out. We have kind of mixed in the market here. So we've given up a little bit of those earlier gains here. S&P pretty much unchanged. The Dow off 0.25%. The NASDAQ up about 0.1%. So some mixture out there. Right now, let's head down to Washington, D.C. We got world and national news with Nancy Lyons.
Thanks, Paul. Secretary of State Antony Blinken is making another trip to the Middle East, his fourth trip to the region since the October 7th attack on Israel. Bloomberg's Sylvia Westphal has more on what's on his agenda.
He's traveling to different countries in the region. He'll be to kind of try and counter this idea that the war could spread and to see what could be the day after for Gaza, what that would look like and how countries in the region will play a part in that.
Bloomberg's Sylvia Westphal reporting. Houthi attacks in the Red Sea have been making shippers nervous, but Lael Brainerd, the National Economic Council director, says those attacks have not yet impacted inflation here in the U.S. She says some shippers are diverting from the Red Sea, which adds to delivery times and delivery costs, but she says the U.S. is less reliant on the shipping in that corridor. The East is bracing for a major winter storm. Forecasters say the storm will be dumping the first big helping of snow the region's seen in 2 years. Today, the storm is expected to pour drenching rain on the Gulf Coast all day and into tonight. The fallout from the resignation of the presidents of Harvard and Penn continues, with civil rights groups protesting the attacks on diversity and equity. Bloomberg's Irv Chapman has more.
Secretary of Education Miguel Cardona was asked his reaction to the uproar on campuses in a Bloomberg interview.
It's our primary responsibility to make sure students are safe and can be unapologetically themselves on campus. I've spoken to students who have felt harassed. We have some very extreme Republicans right now that are looking to higher education to continue their culture wars as they've done with book banning.
Cardona said he is focused on getting more kids into college with career paths that give them and their parents confidence they're getting value for their time and money. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow trading just about at the worst level of the day right now, with the Dow Jones Industrial Average down 85 points, a decline of 0.2%. S&P lower, little changed, actually up 4 points right now. It was swinging between gains and losses here, with the NASDAQ 100 index up 32. That is a gain now of 0.2% on the NASDAQ 100 index. NASDAQ Composite up 24, up by about 0.2%. 10-year yield 4.03%, with a 2-year 4.37%. Spot gold lower, little change, down 0.1% right now. The precious metal at $2,041 the ounce. Bitcoin ahead of a potentially big week next week. We've got Bitcoin lower by 2.2%, 43,516 on Bitcoin. And West Texas Intermediate crude up 1.9% right now. WTI 73.58 a barrel. Indeed, it is Jobs Friday, and this morning we got data showing job growth gathered strength in December, advancing by 216,000. Anna Wong is chief U.S. economist at Bloomberg Economics, and she was a guest this morning right here on Bloomberg Markets.
So basically, even though no rate cuts are here yet, de facto, Powell's dovish words translated to half of 25 bips rate cut, and that could support the unemployment rate by at least 0.2 percentage point through 2024.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Constellation Brands higher after reporting better than expected beer depletions for the fiscal third quarter. Translation, people drinking more beer. Shares of Constellation, they're up by 2%. By the way, Constellation's brands include Corona Beer and Robert Mondavi Wine. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney, we're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well, so go check us out there. When I got my first job on Wall Street in 1986, I mailed letters, snail mail, to every investment bank on Wall Street. The good news is one response, PaineWebber. And that's how I got my job. And thank you, PaineWebber, back in the day. But it was tough. It's a little bit different now, I think.
Yeah, I used to hand out VHS tapes in TV.
That's right,
That's
in
what we used
TV.
to hand out.
Exactly.
Here's my reel.
There's your reel.
It's changed.
It's changed a little bit today. And I actually think it's even beyond LinkedIn, which has been really, really big. There might be some AI involved, because why not? Because AI is in every other part of our life, supposedly. Shannon Ogborn joins us. She's a community lead for ASPE. Shannon, let's start real quick, 30 seconds. What is ASPE? What do you guys do there?
Yeah, absolutely. And first and foremost, thank you so much for having me. One thing that we've really seen in the market in the last couple of years is the uptick in how sophisticated recruiting teams are getting. So the best way to think about ASPE is that we are an all-in-one recruiting software that really combines all of the fundamental and critical components of recruiting. So we're thinking about sourcing and outreach, advanced scheduling, customizable data analytics, and we're putting all of those into a single platform where recruiting teams can really create that sophisticated and streamlined process, which enables recruiting teams to hire the right people for the right role at the right time and do so really efficiently.
And AI is one of those ways where you can kind of reach more people. Can you have any examples of how this technology actually did improve hiring?
Yeah, of course. AI is such a hot topic right now. And I think the most important thing for us is that we're taking a very thoughtful approach to AI instead of just implementing AI for AI's sake. We're focusing on what AI can do really well today, which for us is where recruiters are using a lot of text. So we're talking here about personalized outreach as an example. In a previous world, and I know this from my experience in recruiting, a recruiter would identify a candidate on, say, a platform like LinkedIn, like you guys were mentioning, and they would spend several minutes personalizing the message for higher response rates. Now, through AI tokens and ASPE, our recruiters and recruiting teams can actually do that with a click of a button, which really enables them to send more high-quality outreaches at higher volume with higher response rates, which really increases their pipeline.
So what are the trends you're seeing in recruiting these days? Again, we got some jobs data today that showed that the jobs market's still pretty robust out there.
Absolutely. So there's a couple of things here, and all of these insights from Ashby can be found at ashbyhq.com/blog. But the first thing is that, and this is dependent on our data, which is mostly utilizing, or mostly VC-backed companies use us, and then some IPO'd companies. But we actually saw a decrease in roles this year, but now we're starting to trend upward, which is great. The second thing is that there has been an increase in inbound application volume by 178%. So that's really huge. The third thing is that through our conversations with executives, recruiting teams, hiring managers, quality of hire is more important than ever. The implications of these trends are that recruiters are actually doing more for each incremental hire. And what this means, especially with the sentiment that came out today of hiring really picking up in 2024, is companies need to start thinking about putting recruiters at the head of their hiring plan. Because without an appropriately staffed recruiting team, hitting those important hiring targets is going to prove extremely difficult. So companies really need to think about taking these trends and implementing them into their hiring plan.
How is the talent landscape? How is that evolving in 2024?
It's a great question. It's super dependent on industry, but there are a lot of great candidates on the job market right now. And there's one thing that I will say is that I do think because hiring is picking back up, is companies should really start thinking about how candidates are going to be going through their next job search. So one thing that we found from our data is that after 60 days in process, candidates are exponentially more likely to drop off or decline an offer. So no matter what the landscape looks like and what the talent landscape looks like and who's on the market, there are things that employees are looking for in this job market that companies need to adapt to hire the best talent.
Are employees, are they staying longer or shorter in jobs, or has there been any change in that over the years?
Yeah, well, if you look back really far, people would stay at companies for 15, 20 years or have an entire career stint. In certain industries like tech, people move jobs all the time, and that is for several reasons. One is because of how quickly companies move and how quickly people move up. And then the other thing is that the market can be really tough for places like tech, which we've been seeing as of late. So yeah, that's what I would say is the most relevant thing there, and what's shortening the gap in how long of a tenure people have at companies.
And another trend, recruiting on social media. Is that going to be continuing as well?
Yeah, I have been really interested and impressed to see all of the influencers, especially recruiting influencers on LinkedIn. It's a place that's really dear to my heart, and I love seeing my former colleagues and friends out there on social media. And I do think this is really important because recruiters are the face of a company, right? And so when someone can find a recruiter more accessibly, when the recruiter has been posting a lot about the company, about the employer brand, that actually makes a huge, huge difference to candidates because they feel like the recruiter is that much more invested in the company. So I do think that the trend of social recruiting is just going to keep going up and up and up.
What percentage of companies have recruiting in-house versus, out of house, I guess, as it were?
Yeah, so there's different structures to recruit, how you build a recruiting team. And now I don't have specific percentages, but there's sort of three major functions here. One is in-house recruiters that are full-time employees. The second is fractional recruiting, which has become really, really huge as of late and will continue to increase. And that's when you have someone who's working, as the name implies, a fraction of the time for your company. And then the third way people hire is through agencies. So depending on what your goals are and what you're trying to accomplish and what your internal resources is, that would depend who you have on your team.
Okay.
But
all right, Shannon, really interesting stuff here. Another angle to look at this labor market out there from the recruiting perspective. Shannon Ogborn, she's a community lead for Ashby, a company that helps companies with their recruiting process. And again, a strong jobs number today. We're going to have more coming up. This is Bloomberg. do some company news right now. Steve Rappaport.
Paul, shipping giant Maersk will continue to stay away from the Red Sea due to the risk of attacks from Houthi rebels in Yemen. More on that from Bloomberg's Alaric Nightingale.
The Houthis claim that they're going after ships with kind of an Israeli connection, and a lot of those reported links look increasingly tenuous. But some of these container shipping lines do have offices in Israel. If the Houthis are taking a really wide sort of interpretation of the ships they're trying to attack, then, that might be enough to cause those companies to be wary.
Bloomberg's Alaric Nightingale reporting. Shares of Peloton continue to climb after the company inked a deal with a widely popular social media app. Bloomberg's Joe Easton reports.
They've done this pact with TikTok to put content on this social networking app, and that caused loads of excitement yesterday. The stock rose 14%. Analysts think that this could help them reach more people, get more Pelotons into people's houses, that kind of thing. But they're a little bit cautious on the fact that it will take a while for this to actually materialize into new customers.
That's Bloomberg's Joe Easton reporting. And you might call this odd. The Disney Day Drinkers Club, yes, it does exist. It's adults who enjoy socializing over cocktails inside the parks. They're feuding with Epcot over a literally trashy mascot. It is a dingy garbage can known as Benny, and according to the Wall Street Journal, staff at Epcot decided to relocate the bin, and the club known as D3, they're not thrilled about it. By the way, Benny has its own fan page with thousands of world admirers and was said to be, quote, baptized by a Roman Catholic priest. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
We turned mixed here in the market trading here. We got the S&P 500 up 0.1%, the Dow down 0.2%, and NASDAQ up 0.2%. So from the index level, not a lot of movement there. Yields a little bit higher here. The 10-year Treasury is now over 4%, 4.03% on your 10-year. We've got WTI crude oil up about let's call it 2% here, $73.60, and Bitcoin down 2%, 43,600. We were down at 42,500. So some big volatility in Bitcoin. Right now, let's head down to Washington, D.C. We'll get rolled in national news with Nancy Lyons.
Thanks, Paul. President Biden will be delivering his first speech of this election year today at Valley Forge, Pennsylvania. That's where George Washington mobilized troops during the Revolutionary War. Biden will focus on what he sees as the current battle for the country to preserve democracy and freedom. Quentin Fulks is Biden's campaign manager.
Valley Forge brought those, colonies together to protect democracy. This campaign is going to need to bring together all the constituencies that came together to send Joe Biden and Kamala Harris to the White House in 2020 to make sure that we defend democracy once again and hopefully put this dark chapter that is Donald Trump and the MAGA Republicans behind us.
Today's event was originally scheduled for tomorrow, the anniversary of the January 6th Capitol riot, but was rescheduled due to a winter storm heading for the region. Florida Governor Ron DeSantis and former UN Ambassador Nikki Haley held back-to-back televised town halls in Iowa last night as they vie to be the runner-up in the GOP presidential nomination with Donald Trump, who is holding a huge lead in the polls. Bloomberg's Amy Morris has more from Washington.
DeSantis called Haley a phony who is, quote, playing for voters who are not even core Republicans.
Nikki Haley can't get conservative voters. She's the darling of the never-Trumpers.
Haley focused criticism on Donald Trump, who she says created a massive debt for short-term gain.
In a couple of years, we'll be paying more money in interest payments than we are in our defense budget. You know who notices that? Russia, China, and Iran.
The town halls were broadcast back-to-back on CNN from Grandview University in Des Moines. In Washington, Amy Morris, Bloomberg Radio.
He was half of the fighting TV duo Starsky and Hutch. 80-year-old David Soul has died. He also had a hit on the music charts with this song. Don't give up on us, baby. David Soul's wife says he died surrounded by his family. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg. Now back to you, Paul and Lisa.
Right. Nancy, thank you so much. We appreciate that. All right, here's a story that it just gets a hard no from me, at least for now. Driverless trucks with no humans on board will soon cruise Texas highways if three startup firms have their way, despite objections from critics who say financial pressures, not safety, are behind the timetable. After years of testing, Aurora Innovation, Kodiak Robotics, and Gatic AI expect to remove safety drivers from trucks that are being guided by software and an array of sensors including cameras, radar, and LiDAR, which sends pulses of light that bounces off objects. The companies have already hauled cargo for big names such as Walmart, Kroger, FedEx, and Tyson Foods. All of the companies say they're ready to deploy the technology, though they know there's little to no margin for error. The risk is worth it, they say, because the technology promises to improve highway safety and lower transportation costs.
I don't feel traveling down the highway at these high speeds. They're carrying what, 80,000 pounds of cargo with now no one in the safety spot. I mean, first of all, the Teamsters are probably not going to be happy about this.
That's a good point.
Yeah, and second of all, you had GM's Cruise. I mean, they had problems with robo-taxis. I mean, but they don't have a problem with the truck.
Exactly.
I don't know.
I don't know. I mean, I just got a new car and it's got all the sensors for if you drift out of your lane, and it really works. And it's a great technology, and I think it's going to be really reduce fatalities, and that's great. This is taking it a step further.
This is a completely different ballgame.
We are concerned about the lack of regulation, the lack of transparency, the lack of comprehensive data collection, said Kathy Chase, president of Advocates for Highway and Auto Safety. So there's certainly some challenges out there, particularly from the safety perspective. But this is, everybody says, this is where the industry's going. So we'll pay attention. Lisa Mateo, thanks so much for joining me today. Sound On with Kaylee Lines starts right now.
Now, from our nation's capital, this is Bloomberg Sound On.
Two major stories that we're following here developing before our eyes.
What does it say about Trump's influence on the Republican Party?
What can the Biden administration do on its own to support Israel?
Bloomberg Sound On. Politics, policy, and perspective from D.C.'s top names.
The Republican caucus is at war with itself.
Members of Congress would have a press conference every day if somebody would cover them.
There is bipartisan support for Israel.
This is one of the big ones we only see once every decade or 2 decades in the Middle East.
Bloomberg Sound On with Joe Matthew and Kaylee Lines on Bloomberg Radio.
Welcome to Sound On. Joe Matthew is off on this Friday, but I am Kaylee Lines, and it's not just any Friday. It's Jobs Day in America, and the labor market is still looking strong with 216,000 jobs added in the month of December and a 3.7 unemployment rate. It was an upside surprise today, but what could be good news for Biden? Bad news for the Fed? We'll get the take of Bharat Ramamurthy, who is the former deputy director of the National Economic Council. Plus, we're now just 10 days out from the Iowa caucuses. Nikki Haley and Ron DeSantis both making their case to caucus goers in town halls last night. Rick Davis and Jeannie Shanzano will give us their reactions. Plus, as Congress gets ready to return to Washington with a big fight over the border, Republican Congresswoman Nicole Malliotakis of New York joins me this hour. First, though, let's get a check on those markets. Charlie Pellet, how we looking?
We are down on the Dow, higher on the S&P and NASDAQ, Kaylee Lines. Stocks struggling to hold on to a rebound after a dour start to the year as traders stand by wagers that a March rate cut is on the table. The Dow right now down 85, drop there of 0.2%. Little change, perhaps the key takeaway right now on this Jobs Friday for the S&P, up by 2 points, up less than 0.1%. The NASDAQ 100 index up 24, up by about 0.1%. The NASDAQ Composite up 18, gain there of 0.1%. 10-year yield 4.04% with a 2-year that's now yielding 4.39%, narrowing the gap. We have got spot gold at $2,041, gold down $1.73 the ounce, a drop there of 0.1%. Crude up 2% right now, 71.63 a barrel on crude. Job growth gathered strength in December, advancing by 216,000. Wages also increased. Unemployment held steady at 3.7%. We're on Sound On, so what about the jobs report and politics? Anastasia Amoroso is Chief Investment Strategist at iCapital.
Obviously, it is positive news for the economy and therefore for the president that we got today. The jobs report was absolutely hotter across the board, whether you look at wages that were higher than expected, whether you look at the number of jobs created, and of course the unemployment rate at 3.7%. So that's definitely good news for the administration.
Shares and bonds of Medical Properties Trust are plunging as the company said it had taken steps, including providing some funding to recover uncollected rents from a struggling tenant. Shares of Medical Properties Trust, they are plunging now by 30.5%. Again, recapping, S&P just turning negative on the day right now. Lower, little change, down by 1 point, but in the red. The Dow down 105, down 0.3. NASDAQ up now by 0.1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. Setting us up perfectly for this next conversation, because as you just heard from Charlie, it was a pretty strong jobs report today. I'm not necessarily sure we can characterize this one as a blowout, but still an upside surprise on the non-farm payrolls figure and on wages, and a downside surprise on unemployment, which held at 3.7%. And of course, the low unemployment rate, holding below 4% for a 23rd consecutive month, is something that President Biden has touted repeatedly and touted once again today. He actually put out a statement that said, quote, "This report confirms that 2023 was a great year for the American worker." But if it was a great year for the American worker and potentially a great report for the president, was it the same for the Federal Reserve or for markets that are betting that the Fed is going to be cutting rates in the not so distant future? Let's get a take on that now. I'm pleased to say Bharat Ramamurthy is joining me. He is now Senior Advisor for Economic Strategy at the American Economic Liberties Project, but he's also former Deputy Director of the National Economic Council. Bharat, thanks so much for being here. Do you still look at this labor market and see an economy in need of rate cuts?
Well, I think as you described it, it was a solid, not spectacular jobs report. I think it's important always to look at the revisions in addition to what the report said for the last month. And if you look at the downward revisions over the past couple of months, and look at the 3-month trend, what you have is solid, but not spectacular numbers. And I think, again, that is, broadly speaking, what you would expect to see at this stage of the cycle. There's relatively little sign of weakness in the labor market. And while inflation is clearly trending downwards, it's not at target yet. And for those reasons, I am somewhat skeptical that the Fed is going to cut starting in March. I know that that's what the expectations are. I'm a little bit more skeptical of that. Now, I think that they should, because I think it's good to be proactive on this front, but I'm skeptical that they will.
Okay, I'm not sure that many market participants, at least today, necessarily join you in that view. We have seen some pulling back of expectations really since the Fed released minutes earlier this week that indicate maybe they aren't thinking hikes or cuts rather are coming imminently. And yet that does seem to be where the market is. For the American voter, for the American worker, is it more optimal to have this continued strength in the labor market if it means interest rates stay high? Or is it actually better to see some of that weakness coming through, but that also brings lower borrowing costs with it?
Yeah, it's an interesting question. I think that people underrate the importance of having a strong job market. People think of it as, well, maybe a couple million additional people are unemployed, but everybody else is basically the same. That's not really true. When you have additional slack in the labor market, that affects people up and down the income spectrum. When there's a tighter labor market, companies have to compete harder to make sure that they retain workers and that they attract workers. That creates upward pressure on wages across the income spectrum. And so I think everyone benefits from a tighter labor market. Of course, reduction in interest rates would lead to improvements in things like housing affordability and the cost of credit. I think it really affects people, different people in the income spectrum differently. I think for folks who are on the market for housing, for folks who are looking for credit, the lower rates could mean some amount of increase in affordability. But I think really at the end of the day, we shouldn't be rooting for an increase in the unemployment rate. It really is extraordinarily valuable to have the kind of tight labor market that we've had for the last almost 2 years at this point.
Well, and something that has kept that labor market tight is participation that was lower. And I wonder what you make of the participation figures today. It fell to 62.5%. That's the lowest level we've seen in almost a year. Is that concerning?
Yeah, a little bit. I think that the participation figures can always be a little bit noisy. It's always good to look at longer term trends. When I was in the White House, we tend to look at 3-month and 6-month averages rather than month to month. I would say that it's a blinking yellow light at this point. I'm not ready to declare that there's some sort of clearly negative trend happening yet. But you're right. Ultimately, what you want to see and what we have seen over the course of this recovery is that the prospect of good jobs has attracted a lot of people off the sidelines and into the labor force. And that increase in labor supply has been a helpful element of bringing inflation down in a very healthy way. And so you don't want to see that trend reverse. I'm not ready to declare that that trend is reversing yet, but it is something to keep an eye on as we go into future jobs reports.
Okay, so let's talk about the trend in inflation. How much do you think the Red Sea and what's happening there, the disruptions to transport, the elongating of these vessels' journeys around the coast of Africa, higher freight costs as a result, maybe even higher fuel prices, depending on actually what happens in the Middle East, how great a risk is that to the inflation story?
It's certainly a risk. I mean, look, during the pandemic and in the aftermath of the pandemic, we saw how exactly these types of supply-side disruptions can contribute to rather sharp increases in inflation. Remember, during the pandemic, we saw in some cases a 10x increase in the cost of ocean shipping, which then flowed through to increases in the cost of all sorts of products that American companies and American consumers rely upon. I think you could see, to a lesser degree, that kind of upward pressure on prices because of these disruptions. It's one of many reasons why it would be useful to try to resolve that as quickly as possible.
Yeah, and of course, you speak of supply chains. Progress made on supply chains is something that this White House has frequently touted, just as they have frequently touted the low unemployment rate, all of the job growth that has happened under Biden's presidency. And yet it hasn't, as you well know, reflected necessarily in polling, in his economic approval rating. Now that you're outside the White House, looking in, what do they need to change to actually get that to resonate?
Honestly, I don't think that they need to change course very much. I think that what you are seeing in terms of the disconnect in economic data and economic sentiment is mostly explained by the fact that there's always going to be a lag. You know, look, we in the White House celebrated when wages started rising higher than inflation and real wages turned positive. But if you're an ordinary person out there, you're not going to switch on a dime the second that real wages tick over from negative to positive. You want to see a sustained set of time when inflation is coming down, your take-home pay is clearly allowing you to pay for the things that you need at the grocery store and at the pump. And I think what you're starting to see now that it's been several months of real wage gains, inflation is starting to recede a bit, is that the sentiment data is ticking up. You see it in the consumer board information, you see it in the Michigan sentiment data, you see it in some of the polling data about the president's economic approval. All of that stuff is starting to tick up. And I would be surprised if it doesn't continue to tick up over the next several months as the salience of inflation recedes.
Well, the ticking up, though, of those confidence metrics probably is reliant on the fact that we actually don't get a recession, that the landing is soft. Do you think that's fully assured at this point?
I'm hesitant to say that anything is fully assured. If there's one thing I learned from my time at the White House is that you have to expect the unexpected. But I would say that all of the data that we have available to us right now about the state of the labor market, about consumer spending, about business investment, all seems to suggest that we are going to have a soft landing. Now, there are things that can disrupt it, as you just noted. Some of the disruptions on the shipping side could send inflation moving in the wrong direction. You could have other geopolitical events that could end up pushing us in the wrong direction. But based on the data that we have available to us right now, we're certainly on a path to a soft landing. I know that Secretary Yellen made a similar point just earlier today. So I would have a lot of optimism on that front. And if, in fact, we can secure that soft landing, and what we have over the next several months is inflation at or near the target, continued steady job growth, I would be very, very surprised if you don't see consumer sentiment and economic sentiment go up quite a bit in the months to come.
How much does fiscal risk factor, though, into ultimately economic outcomes? Knowing Congress is getting ready to return to Washington next week, there's going to be a big fight over appropriations ahead, with the threat of not just a shutdown, but potentially a 1% cut across the border sequester come April if they really can't sort this out. How concerned should we be from an economic standpoint?
I think from a macroeconomic perspective, we shouldn't be overly concerned. If you look at analyses of past shutdowns, for example, I was working on Capitol Hill back in 2013 when there was a month-long shutdown. The data tends to suggest that has a pretty limited impact macroeconomically. Now, of course, there is a significant impact on people's lives, on millions of federal employees, on people who rely on certain forms of government services who are not going to get those in a shutdown. And if you see some sort of prolonged locked-in reduction in government spending over the long term, that would be a risk. I don't think we're at any risk of that happening. If we're going to have some sort of 1 week, 2 week shutdown as people sort out these issues, I don't think that's much of a risk from a macroeconomic perspective.
All right, Bharat Ramamurthy, thank you so much for joining the program on this Jobs Day. He is Senior Advisor for Economic Strategy at the American Economic Liberties Project and, of course, former Deputy Director of the NEC, reflecting on today's Jobs Day. Let's get the reflections now of our wonderful Bloomberg Politics contributors. Rick Davis and Jeannie Shanzano are with me. So, Jeannie, I'll pose the same question to you that I essentially asked Bharat a moment ago. Is Biden actually able to use a jobs report like this to his advantage when he hasn't been able to tout the strength of the economy successfully much at all?
He's got to keep reminding people that the numbers look very good, and at the same time to acknowledge that, as you were just talking about, there is a lag, and so they may not be feeling that yet due to the inflation pressure. So, it is a very hard line for the president to walk, but it is an astonishingly good report. 23 months, Kaylee, you mentioned, it's stunning numbers that are much better, I think, than anybody could have expected. And hearing Janet Yellen talk about the fact that this soft landing may be in the offing, that is all very good. It hasn't translated politically yet, unfortunately, for the president, but the team feels fairly confident that in the coming months, as that we beat that lag, that they may be able to benefit from it politically. But it's a hard message to sell when people are still feeling inflation as they go to the store and elsewhere.
Well, and Rick, knowing that Biden has really struggled in terms of actually getting voters to recognize his economic accomplishments, is that why we're seeing such a big deal made. Perhaps actually you could even call it a kicking off fully of his election year campaign efforts in Valley Forge, Pennsylvania, to talk about Donald Trump being a threat to democracy. Is this really his best remaining strategy?
Yeah, look, obviously that linked to his his speech today linked to January 6th, the anniversary of that. It draws you to that conclusion to talk about democracy under threat. But the reality is he can't give enough speeches about the economy. As Jeannie points out, he is not considered credible on this. He's got one of the lowest presidential ratings on managing the economy. Trump beats him significantly. And he's got to fix that if he wants to get a second term. The good news is, as pointed out in today's report, he's got plenty to talk about, but I've yet to see this administration really fan out around the country to promote what he likes to call Bidenomics. And one speech a month is not going to get it done.
Well, Rick, how much would he be helped by Fed cuts? Knowing how familiar you are with timing in campaigns and how it may work for you or against you, at what point will minds already been made up enough on the economy that therefore even Fed cuts aren't going to change the mind of a voter? Or I guess that's just my question. Does it matter when the cuts come, or people will already have made decisions by the point that they do?
Yeah, it matters. What we're seeing right now is what we historically have seen in campaigns, which is a pretty significant lag between any kind of good news and an improvement in the ballot, improvement in the public image of the president around something like the economy. It seems voters are always negatively inclined. If there's something bad happens, they change their mind immediately. But when good things are happening, it takes a month, 3, 4, 5, 6 months to really internalize the improvement. So the sooner the Fed could act, if they do, on rate cuts, the better it would be for Biden. He has not got much credibility on inflation and fighting it. More voters will tell you in a focus group that they didn't take it seriously than the fact that, they're doing what they need to do to tackle it. And so the same will apply. If the Fed starts to cut rates soon, there'll be a lag, but that lag will actually, I think, inure to the benefit of the Biden campaign.
All right, Rick Davis and Jeannie Sheehan Zaino will be sticking with me. Just a note on how voters are feeling about the economy. Producer James points out the Suffolk USA poll earlier this week, 30% said they think we're in a recession. Only 29% said they think it's an economic recovery, 21% stagnation, and 16% depression. So not necessarily encouraging for the incumbent administration. But coming up, we're not going to talk about the incumbent. We're going to talk about the Republicans trying to kick him out of the Oval Office in this 2024 cycle. That's next. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. After 9 winning weeks in a row, we are looking at a down week for the S&P 500 index. A down Friday right now with the S&P lower by 1 point. Little change there. We've got the Dow down 92. That is a drop of just about 0.3%. NASDAQ higher, holding on to a gain of 1 point now. Was down just a moment ago. The NASDAQ 100 index up 4 points. Also little changed. 10-year yield 4.04% with a 2-year that's now yielding 4.40%. Spot gold down $2 the ounce to $2,041, a decline of 0.1%. And West Texas Intermediate crude up 1.9%, $73.55 a barrel. Tesla is recalling virtually every car it has ever sold in China because of issues with the driver assistance system autopilot that increase the risk of crashes. Tesla shares, they are trading lower now by just about by 0.4%. Again, recapping, we do have stocks lower, S&P little change, down now by 1 point. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
This is Bloomberg Sound on Bloomberg Radio.
Welcome back to the fastest show in politics, and talk about things going fast. Iowa already is almost upon us. We are in the middle of now a 10-day countdown. It is just 10 more days until the all-important Iowa caucuses, where, yes, it is highly likely that former President Donald Trump is going to win. Polls show him ahead by a significant margin, polling at north of 50% in a lot of polls. So I'm not sure we can call it a real contest yet. The question is, can Nikki Haley or Ron DeSantis put up a strong enough showing in Iowa that it becomes more of a contest? They certainly are competing fiercely for the second place position here, and they were each making their cases last night in CNN town halls. Interestingly, though, they took more barbs at Donald Trump than each other, which is a bit of a reversal from what we've seen so far this cycle. Here's Ron DeSantis last evening.
Do you think Donald Trump is not pro-life?
Of course not. I mean, when you're saying that pro-life protections are a terrible thing, by definition, you are not pro-life. When you say that you want to have a federal law at 18 weeks or 20 weeks that would override a state like Iowa that has enacted pro-life protections, that would mean more abortions, not less abortions.
He went on to also criticize the former president for failing to keep his promises on the border wall, as well as spending. Meanwhile, here's Nikki Haley on Trump.
For me, it's not about guilt or innocence. It's about what's in the best interest for the country. And I don't think our country will move forward with an 80-year-old president sitting in jail that allows our country to continue to be divided. We have to move on past that.
She also said chaos follows Trump and that the country can't take another 4 years of chaos. So on that note, let's bring back Rick Davis and Jeannie Shan Zano, our Bloomberg Politics contributors. So, Rick, what'd you make of their hits at Trump last night? Were they strong enough?
Yeah, I mean, this is the first time we've seen them both, as you point out, lean in against Trump and not lean into each other. So I think they've figured out who's actually winning the election so far. So that's instructive, too. I think that the attacks are nothing new. They've kind of reprised these throughout their campaign, but the fact that they've ramped up many of them in the same event is indication that they're feeling a little bit of the pinch. I would say much more important for DeSantis to contrast with Nikki Haley, because if there's any chance that he gets a, quote, ticket out of Iowa, it means he's got to come in second. I can't imagine a scenario where he comes in third and is currently polling anemic figures in New Hampshire. And the two of those things in combination are a death blow to his campaign. Wouldn't surprise me that he has an election night in Iowa like Howard Dean did in 2004, where there's a little bit of screaming occurs.
Okay, I want to get back to how the margin of second may matter here and what that ultimately means for New Hampshire. But Jeannie, first I want to ask you about something else Nikki Haley frankly had to talk about last night, which was her Civil War gaffe, the idea that she did not attribute slavery as a cause of the Civil War previously. And part of her response, she said, and this is a quote, "If you grow up in South Carolina, literally in 2nd and 3rd grade, you learn about slavery. You grow up and you have, I had black friends growing up." Does that help her get out of the hole or dig it deeper?
Digs it deeper. This was a huge misstep by Nikki Haley a few weeks ago. She keeps getting asked about it. And, I thought she actually performed pretty well last night. But as you wake up and you see the Twitter feeds and you see what's being reposted and shared from the night, that line that you just mentioned, Kaylee, about "I have black friends," that's really what we're left with. And so that is a problem for her. And so, is it going to be a wound she can't recover from? Absolutely not. But I think in many people's minds, it's indicative of what DeSantis and Christie and now Donald Trump, as he's hitting her more forcefully as he sees her rising in the polls in New Hampshire, have said, is that she is trying to be all things to all people and that she is not authentic, not saying what she actually believes. I think there was actually like a 9-year-old kid in New Hampshire who asked her the other day, something about her being a flip-flopper like John Kerry. I don't know how a 9-year-old remembers John Kerry, but that's what's in people's minds. And so I do think it's problematic for her. I thought, again, she did a good job on the night. But when, in this media era, when everything is shared, that's the clip we're seeing of her. It does become a bit of a problem for her.
So it raises the question of how strong a showing she might actually be able to put up in 10 days' time. So, Rick, to return to you on the question of, obviously, Donald Trump is going to lead Iowa, barring something completely unforeseen. It's about number 2 and how close number 2 is to Trump number 1, right? What kind of margin does Nikki Haley actually need to make New Hampshire actually in play?
Yeah, first of all, she's already got New Hampshire in play, right? In all the most current polling, she's hovering around 10% behind Trump. That is way up from just 6 months ago. So New Hampshire is a race today. And so what she's trying to do is figure out what she can do to add to that momentum, which is why she's placed a massive $30 million buy in Iowa. And with all due respect to social media, when you've got $30 million worth of commercials pounding away in 3 media markets in Iowa, you're controlling the message. And the message that she has is that she's electable. She can beat Biden. And that's what Republicans want to hear. They care a little bit less about DeSantis and Nikki Haley than they do about Joe Biden. And so if you tell them that you can beat Biden and you show it in the polling data that's circulating, you've got credibility. And so she's actually waging a pretty credible argument, and it undermines Donald Trump's arguments of electability. So it works both in New Hampshire and in Iowa. So if she does sort of surprise everybody and come in second in Iowa, she will get a boost going into the New Hampshire campaign. And then the question is, what can she do with it? If DeSantis comes in second place, it's pretty much what he has said all along that he was going to do. In fact, he's actually said he was going to win Iowa, which was a mistake. But then the question is going to be, where does he go from here? Because he has no campaign in New Hampshire. He has no campaign in South Carolina. There aren't a lot of Super Tuesday states that are good for DeSantis. And so he'll have to come up with a narrative on election night that says somehow he can go from here to, from Iowa in second place to a victory somewhere. And at least Nikki can point to the fact that she is closer to Trump than any candidate has been since Ron DeSantis got into the race in New Hampshire. So all eyes will shift immediately from Iowa to New Hampshire, and we'll see whether or not its impact, the Iowa election, has anything to do with the New Hampshire outcome.
Well, we'll also see, Jeannie, if there are just fewer candidates in play come New Hampshire. It's not just a question of whether Ron DeSantis moves on past Iowa, but there are other players in this game as well. Chris Christie and Vivek Ramaswamy. How likely is it in your mind that we see a consolidation of the field before we actually get up there to Manchester?
We really should. I mean, if you think about Chris Christie's campaign, it was predicated on ensuring that Donald Trump is not the nominee of the party. Well, if that's the case, and he has zero paths, and really he has less than zero path to victory here, then you would think he would bow out and allow his supporters to go where they go. You know, maybe Nikki Haley, maybe they look elsewhere. But, you know, I think we should see something like that if he was true to what he said. And of course, Vivek Ramaswamy, he's barely showing in the polls at this point. He really does seem to be playing for a vice presidential or a cabinet spot at this point. I don't know if he's going to need to make a statement because he already seems out of it. But, you know, I do think that the really interesting question is going to be for Donald Trump, who keeps talking about his 50, 60 point, 40 point victory and lead in the polls. And what happens if either of these candidates, in DeSantis or Haley, does better than expected? It's a dangerous game Donald Trump is playing by making that case. And, you know, he's going to have to eat that if one of them or both of them does far better than expected, which is possible given DeSantis's ground game in Iowa and what Rick was just talking about with Nikki Haley's money in Iowa that she has to spend on the media.
Yeah, 99 counties visited for Ron DeSantis. Donald Trump himself hasn't really spent much time in Iowa at all, though he will be there next week when he's counter-programming the Haley-DeSantis debate with a Fox town hall. So obviously all of us are going to be tuned in. We got to talk about Congress returning to Washington next with Rick Davis and Jeannie Shan Zano. But you know who's already in Washington? Nancy Lyons. She's here with world and national news from our 99.1 newsroom. Hey, Nancy.
Thanks, Kaylee. Well, a winter weather system is moving through the U.S. and is expected to hit the East Coast this weekend with a mix of snow and freezing rain from the southern Appalachians to the northeast. Bloomberg meteorologist Rob Carolyn says there will be some areas with substantial accumulation.
Along the coast, there'll be a couple of inches. As you work your way inland, it goes up to 3 to 6 inches. And then the suburbs, well, north and west of Boston and New York City could see as much as 5 to 8 inches. 3 to 5 inches looks possible in the suburbs north and west of the district in Baltimore.
That's Bloomberg meteorologist Rob Carolyn. Well, the situation is escalating in the Red Sea, where Iran-backed Houthi forces continue to target commercial ships. This despite the creation of a U.S.-led task force that's aimed at protecting passage to the Suez Canal that carries 12% of global maritime trade. We get more with Ellen Wald. She's a senior fellow at the Atlantic Council.
These actions that the Houthis are taking are having reverberations all around international shipping. I mean, rates are up 88% pre-pandemic, simply because of what we're seeing in the Red Sea. So this isn't just a local or isolated issue. This is having large-scale reverberations.
The Atlantic Council's Ellen Wald. Well, the National Economic Council Director, Lael Brainerd, says so far the diversion of shipping vessels in the Red Sea has not impacted inflation here because the U.S., she says, is less reliant on that shipping corridor. Some other positive economic news today. Job gains and wage increases in December exceeded expectations, and Treasury Secretary Janet Yellen says the U.S. has achieved a long-sought soft landing. That's a historically unusual event in which high inflation is tamed without significantly damaging the labor market. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg, and we begin with word of a possible deal in the tech world. Synopsys said to be in talks to buy Ansys for $400 a share. This, according to the Wall Street Journal. Right now, we got Synopsys trading lower by 0.8%. Ansys up by 1.25%. But again, repeating the headline, Synopsys in talks to buy Ansys in a $400 share deal. This, according to the Wall Street Journal. Well, stocks have turned around since our last update. We do now have the Dow, the S&P, and NASDAQ all advancing back in the green right now. 12-point gain for the S&P, up by about 0.3%. The Dow higher by 46, higher by 0.1%, while NASDAQ is up 44 points, up 0.3%, and the NASDAQ 100 index is advancing right now by 55 points, up 0.3%. The 10-year 4.03%. We have got the 2-year 4.38%, narrowing the spread there. Spot gold up $2 the ounce to $2,045, up by about 0.1%. Crude up 2.3%, $73.85 a barrel. Good news for Wall Street in this morning's jobs report, as we hear from Bloomberg's Vinny Del Giudice.
The Labor Department reports job growth picked up in December, a gain of 216,000. Wages rose, unemployment held steady at 3.7%, and the breadth of job gains improved. December's jobs report caps a year when America's labor market moderated from its post-pandemic recovery without sinking. Healthcare, government, and construction led last month's employment gain. Vinny Del Giudice, Bloomberg Radio.
So all about jobs today, but 1 week from now, it'll be all about the banks when we start getting bank earnings fast and furious, as we hear from J.P. Morgan Chase, Citigroup, Wells Fargo, and Bank of America. That's all next Friday. JPM, J.P. Morgan Chase, up now by 0.7%. Citigroup up 1.3%. Wells Fargo up 1.8%. Bank of America up by 2%. Recapping stocks back in the green. S&P up 13, up 0.3%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
You're listening to Bloomberg Sound on Bloomberg Radio.
I'm Kaylee Lyons, counting down to the weekend because, yes, it is almost here. And that means it is also almost time for members of Congress to get on their airplanes and come here back to Washington. The Senate returns on Monday, the House on Tuesday. And boy, do they have some big fights waiting for them upon their arrival to Capitol Hill. A, you need to figure out a way to fund the government past the deadlines of January 19th and February 2nd. B, figure out a deal on border security. And C, hope that unlocks the supplemental funding request from the White House for emergency aid to both Israel and Ukraine. And it seems that the latest development is actually that the border is tied to both A and C. The appropriations process, not just the supplemental. Also, Bloomberg reporting today that House Speaker Mike Johnson is considering seeking direct talks with Biden on border policy. Of course, to this point, those talks have just been between the White House and negotiators in the Senate. So on that note, let's bring back our political panel, Rick Davis and Jeannie Shan Zaino. So, Jeannie, why haven't Johnson and Biden done this already? Haven't we always known that the keys actually are held by the House, not the Senate?
Yeah, I'm still following your A and C. That was beautifully said, and it made me very nervous, Kaylee. The key is going to be with the House, because we do know that regardless of what the Senate does, it's going to be the House that is the key in the way you said it, to passing something. I wish the president would take Johnson up on that, but I think in defense of the administration, it's really hard to take him seriously at this point. He's got his right flank saying they are threatening a shutdown of the government if they don't get a border deal. You have Johnson. I'm glad to hear he is now talking about negotiating, but the last we heard from him, it was HR 2 or nothing, which is hardly a negotiation. And then, of course, you have Shalonda Young saying if he's really serious, he moves on over to the Senate and negotiates there and then sends the bill to the House. To the president, rather, in regular order. So you know, do I hope the president talks to him? I'm not opposed to talking, but I have a hard time taking him seriously on this.
Well, and a lot of this is, at the end of the day, just about hope. Hope, Rick, that eventually a deal will be reached. How hopeful are you that that actually happens?
Yeah, I really thought we were set up for some kind of a deal on the return of Congress, but the Senate has sputtered to a near halt. And, you know, I think by taking 60 House members down to the border, he's gotten everybody all excited, the Speaker has, and frankly, I think sent shockwaves to the administration that now it's a big step backwards. And as Congressman Chip Roy has pointed out in his letter that he circulated to the delegation, you know, we shouldn't be just talking about a deal on the border vis-a-vis the supplemental. We should be making sure that it's embedded in the budget to the appropriations bills. And so that has upped the ante substantially. So I'd say at this point, the first deadline is January 19th for the first, I think, 6 or 5 appropriations bills that are queued up in the tier. And I'm not very optimistic that they're either going to pass those in sort of a normal order and have those appropriations bills passed and ready. And that may lead to a government shutdown, you know, by the middle of this month.
Yeah, well, Jeannie, when Congress went home for the holidays, we already thought the odds of a shutdown, or a partial shutdown at least, come January 19th were very high. Have they only gotten higher in their absence?
They have. They seem to get higher every day. I mean, you think about January 19th, that is 2 weeks away. And they are talking about tying the most intractable problem in modern American history, what's happening at the border, hasn't been resolved for decades, to passing the budget. It is the height of insanity to me, and I'm sure to many other people. The regular work of Congress needs to be done, keeping the government open, passing a budget, and yes, dealing with the border, but tying those together is going to all but ensure, if they keep along that line, that neither one gets done and we are shut down or partially shut down in just 2 weeks, which is, you know, not good news for an economy that is doing better and a market that is doing better, or anybody living in the United States or abroad that's looking at our economy.
All right, Jeannie Shanzano and Rick Davis, our wonderful Bloomberg Politics contributors, thank you so much. I'll see both of you later on this evening on Balance of Power. But I want to return to someone that Rick just mentioned a moment ago, Congressman Chip Roy, of course, a Republican from Texas. I actually spoke with him on Balance of Power last night and asked him about this idea that it's either shut down the border or shut down the government. And this is what he told me.
We need to pass H.R. 2 or we need to withhold funding until we get it. I mean, if you read Federalist Papers, if you look at the founding of our country, our job, Article 1, is to hold the funding and to use it to force an administration that is ignoring the law to do their job. Here's my question. What would people have us do? Just say, whatever you want to do, Alejandro Mayorkas, whatever you want to do, Joe Biden, blatantly ignore the law while people die? And so, to all my Republican colleagues who are going around going, oh, we might have a shutdown. What happens with the government? You go talk to the people of Texas or people in your community.
That was Congressman Chip Roy. Let's get another view now from another Republican member of the House. Congresswoman Nicole Malliotakis of New York, I'm pleased to say, is with us now. Congresswoman, thank you so much for being here. Do you agree with this strategy? Shut down the government if you don't get what you want at the border?
Well, look, I think it's a lot more complicated than that. I mean, I believe in good faith negotiation. I think we have to try to use our leverage, right, in this process to push the Senate to make real advances in border security, which means we have to revert to some of the policies of the previous administration. But we need to have a negotiation. I would say we passed H.R. 2, right? That was the House Republicans' priorities. And basically, it's what Customs and Border Protection, if you spoke with their union, that's what they're saying they want, okay? They want technology, they want tools and resources, manpower, but they also want policies that restore the order at the southern border, that undo President Biden's executive orders. It addresses some of the asylum issues. It addresses some of the issues with visas. And I think it would be really it would be a tremendous resolution to what we're seeing at the southern border. Now, if the Senate doesn't want to pass our bill, then the Senate should pass its own bill. Let the Senate pass its own bill of what it sees as priorities relating to the border, and then let's negotiate and reconcile the differences. We passed our bill in May, and yet we have Senator Schumer refusing to not only allow our bill to the floor for a vote, which I strongly believe if Schumer brought H.R. 2, Border Security Act, to the floor for a vote, it would pass. He refuses to allow a vote. All we're asking for is an up and down vote. If it doesn't pass, then we got to start from scratch. Or pass your own bill, and then let's reconcile those differences. But what we're seeing happening is so unsustainable. It is so destructive to communities like ours here in New York City. The mayor is screaming, saying that this is going to bankrupt New York City. They're going to freeze hiring police officers, across the board cuts. And yet Senator Schumer, who represents New York City, refuses to take any action. So we have to use whatever leverage we have. I don't want to shut down the government, but we need to demand that border security be part of this resolution. We're not going to continue to give money to Homeland Security to simply process paperwork. They actually need to secure the border.
Okay. So, Congresswoman, you speak of negotiation and this idea that the Senate should come up with something of their own and pass it first. Yet there are many members of your conference who are saying H.R. 2 essentially or nothing, that H.R. 2 ultimately is all they settle for. So if you're Mike Johnson, the House Speaker, is that all he can settle for? Or you think actually, knowing what happened to the prior Speaker, Kevin McCarthy, he's going to be able to pass something passed by Democrats in the Senate in this House of Representatives?
Well, look, H.R. 2, I think, is an ideal piece of legislation. However, look, I'm a Republican from New York. I'm in an overwhelming Democrat state, and I know that we have to negotiate with the Democrats, as much as I may not like it sometimes, to get anything done. And so what I would say is H.R. 2 is the Republican starting point. But that's why we need Senator Schumer to either allow a vote on our bill, okay, which again, I think it would pass if he brought it up, even though the Democrats control the Senate, or pass your own bill, and then we can reconcile the differences. And we would have to give a little. Yes, we'd have to give a little. But certainly, as long as our main provisions, right, that would make sure people are not released in the interior of this country, making sure that people have to wait in the next safe country as they apply for asylum and go through an orderly process so our courts are not backlogged to the point where they are right now, which is a 10-year wait, making sure that we add more judges to alleviate this backlog, making sure that we're not taking these individuals who are paying the drug cartels to cross our southern border before the people who have come legally and have been waiting in the system for years. Right now, the way the system Joe Biden has it set up is the border crossers are being heard first. And so the people who have been waiting patiently, doing everything right, following the rules, didn't pay the drug cartels to come here, they're getting pushed to the back and they're getting years-long delays. And I know this because I've been working personally with many cases, constituents, and I've had to cut through this bureaucracy and red tape for them. And it's very unfair that the president is prioritizing the people who pay the drug cartels to be smuggled here, as opposed to the ones who have been waiting in the system. So I would simply say is I understand there's a give and take here, but it's hard to negotiate with the Senate when they've passed nothing. We need to see what their priorities are, right? That's how it works. We show you our cards, you show us yours, and then we try to reconcile the differences and get a piece of legislation passed.
So, Congresswoman, there's the Senate and the House obviously in play here, as well as the White House, because Biden's ultimately going to have to sign this legislation. And knowing that Biden does need a win on border policy politically, do you think there is another actor here for House Republicans in the man who is very likely going to be running against him in the general election in 2024? How much influence does Donald Trump have on the people in the House making these decisions right now?
Well, I don't think I think the House Republicans want border security. That is our #1 priority. We want to see reasonable policy. And yes, we have legislation to add more visas for people that want to come and work and provide for their families in industries that we need workers, right, to address our labor shortage, and it should be strategic, and we should be doing that. But this idea that we're just going to allow 10 million people to enter our country, 2 million of which we don't know who they are, where they are, or what their intention are, that's the number that CBP estimated has entered our country, is very dangerous. When we know fentanyl is killing a record number of Americans. We know that there's sex trafficking, children, women being exploited. When we know that we've caught terrorists at the border that are on the FBI watch list. I mean, this is insane that we would have this type of open border policy in a post 9/11 world. So I think the House is working independently, and this is their priority, regardless of any national figures. I mean, we see this as a real issue, both economic issue, a public safety, national security issue, and it just needs to be addressed. And if Joe Biden will not do something like rescind the executive orders that created this, his executive orders that created this mess, then we need to take action. We got to use every tool and leverage that we have to get the Senate to act.
Well, Congresswoman, you say the House is going to make these decisions independently of any actor. So is that essentially you saying even if you do have the former president potentially making noise about a deal, that Mike Johnson and House leadership, which pretty much everyone has endorsed him at this point, would pass it anyway?
Look, I think you'll have the votes. If we actually get the Senate to work with us and we can hash out an agreement that would reinstate some of the Trump-era policies, address the issues of visas and asylum and work permits for people who are going to come legally and follow the proper path, then you would see what you usually see in these types of scenarios, right? Like you did in the debt default, you did it with avoiding the shutdown. You'll see the far right vote against it, the far left vote against it, and then everyone else in the middle voting for it. Over 300 probably members voting for it. That's what usually happens at the end of the day when there is a negotiation. The extremes sit it out, they vote no and complain about it. And then the middle, who actually have to govern, right? We pass the legislation, do what we can. People have to understand that Republicans, we control 1/3 of the government, right? The Democrats have the Senate, they have the White House. We need to negotiate. We're not going to get everything we want, but if we can get some really good wins that actually address the crisis and stop this mass migration flow to New York City that's hurting cities like ours and we can't afford it, and we're seeing citizen services being cut as a result, well, then that's a win and we should do it. Regardless of who, at the end of the day, will take political credit for it, we need to do the right thing.
Okay, well, you've mentioned New York a few times, so let's talk specifically about what's happening there. Obviously dealing with an influx of migrants, many of which have been bused from Texas. And I'm sure you saw the news yesterday. New York is now suing 17 Texas bus companies for $708 million to recoup costs incurred by providing shelter and services to these migrants. Do you agree? Do you support that move, Congresswoman?
Look, I support any tool that's going to stop this flow. I think a lot of the problem of these non-government organizations, these NGOs that receive a lot of government funding, they are responsible for transporting the majority of the migrants. Yes, states like Texas are sending some, but that's about 10 to 15% of the individuals that we're seeing in New York City. So I support any measure that will stop it, but truly, what's really going to stop it is if we secure the border, right? At the end of the day, it comes down to that. And so I really urge Mayor Adams to get Senator Schumer to act. And he calls for more funding. Which would only exacerbate the problem, right? It would just allow him to open up more shelters and more encampments in New York City, and it may help the city financially, but doesn't really solve the problem. What's really going to solve the problem is having border security and a reasonable process for people, which we do, by the way. We have laws, and for generations, people have been coming, including my own parents, to this country. We have a process in place. It needs to be followed. It needs to be enforced. And that's what we need. We need more resources to make sure that these cases are heard quicker.
Congressman, finally, I only have a minute left with you, but I do want to make sure to ask this question. How confident are you that a partial shutdown on January 19th can be averted?
You know, I think there's a lot of variables right now, so it's hard to say. Look, they've said we were going to shut down.
Is it more likely than not?
I would say a partial shutdown would be more likely than a complete shutdown. But I also think that, you know, people have said we were going to have shutdowns twice before in this Congress, and we didn't. We averted it last minute, working in a bipartisan way. But at some point, we need to see policy changes. We don't want to just continue the existing funding levels. We have a $34 trillion debt. We need to be serious about spending, and we got to find savings. And so that is why negotiating is so important right now.
All right, and on that note, we will leave it. Congresswoman, thank you so much for your time. Safe travels back to Washington next week. That is Republican Congresswoman from New York, Nicole Malliotakis. We'll have much more coming up next on the second hour of Sound On, so stick with us. This is Bloomberg.
from our nation's capital, this is Bloomberg Sound On.
Two major stories that we're following here developing before our eyes.
What does it say about Trump's influence on the Republican Party?
What can the Biden administration do on its own to support Israel?
Bloomberg Sound On. Politics, policy, and perspective from D.C.'s top names.
The Republican caucus is at war with itself.
Members of Congress would have a press conference every day if somebody would cover them.
There is bipartisan support for Israel.
This is one of the big ones. We only see once every decade or 2 decades in the Middle East.
Bloomberg Sound On with Joe Matthew and Kaylee Lines on Bloomberg Radio.
I'm Kaylee Lines, flying solo today. Joe Matthew will be back on Monday, as will members of Congress, because, yes, they return to Washington next week with big fights over spending ahead of them. We'll have more on that with Bill Hoagland of the Bipartisan Policy Center coming up this hour. Just how high is the likelihood of a shutdown or a partial one come January 19th? Plus, with Secretary of State Antony Blinken in the Middle East, we'll get a read on the situation in the region with Bloomberg's Nick Wadhams and Lee Klaskow of Bloomberg Intelligence. And finally, this is the most consequential presidential election since World War II. That's what Larry Summers, the former Treasury Secretary, told our David Weston, and David will join me this hour with more. First, though, let's get a check on these Jobs Day markets, because, boy, those payrolls were strong. Charlie Pellet, how the market's looking?
We are higher across the board right now, but Kelly, it has been a choppy session. Stocks have been struggling for direction after a dour start to the year. Traders clinging to bets that a March rate cut is still on the table. Right now, we've got the 10-year 4.03% with a 2-year at 4.38%. S&P up 13 points, up by about 0.3%, has been swinging between gains and losses. The Dow higher by 49 points right now, up by about 0.1%. And NASDAQ is up 46. That is a gain of 0.3%. NASDAQ 100 index up 53, an advance there of 0.3%. Bitcoin lower by 2%, 43,592 on Bitcoin. Gold up $5 the ounce to 2,048, up by 0.3%. And crude oil now higher by 2.3%, 73.86 a barrel. Job growth gathered strength in December, advancing by 216,000. Wages also increased. Unemployment held steady at 3.8%. What about the political implications in today's jobs report? Michael Collins is Senior Portfolio Manager at PGIM.
You know, it's actually remarkable that that Biden's approval ratings are so low when you actually have had a really strong economy, a super strong labor market, really strong financial markets, and still, you know, not seeing any love from voters there.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. And, of course, we will have more coming up on Jobs Friday on this morning's data from our Michael McKee. Again, recapping here, stocks are pushing higher. The Dow, the S&P, NASDAQ, all advancing, up now by 12 points on the S&P, up 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pellet running us through those Jobs Day markets. Thank you so much. And we want to get more on the jobs figures now because 216,000 payrolls added in the month of December. Economists thought it would be 175,000. And rather than a 3.8% unemployment rate economists were looking for, what we got was 3.7. Wages were a little hot as well. So what does all this mean? And what does it mean specifically for the Federal Reserve? Let's get more insight now with Bloomberg's international economics and policy correspondent, Michael McKee, who is also in New York. So, Mike, I guess my first question is it as strong under the surface as meets the eye?
Not quite, and it's a little weird under the surface. There are a number of different oddities in this report, none of which are really going to matter to the Federal Reserve. But the 216,000 has to be weighed against the 71,000 that were subtracted from October and November, so you get a net of 145,000. And we were running in the third quarter at about a 225,000 average pace, so clearly there's a deceleration here. And the fact that the unemployment rate did not go up was because a lot of people left the labor force, but most of those people didn't lose their jobs. They just were not in the labor force, so they're not counted as unemployed. So we don't know exactly why they went out, other than maybe it was the holidays and they didn't feel like looking for work or something like that. And finally, and this gets into the political side of things, the unemployment rate for blacks and for Asians went down, while for whites, it went up. And usually, if you're going into a recession or something like that, it works the other way. So a lot of things to consider when looking at this report. But as I said, I don't think the Fed is going to change its views one way or another based on this.
Well, Mike, I guess it's important to recognize here that the Fed's views on cutting may be different than the view the market has adopted on cutting, because the market thinks the Fed's going to be cutting a lot more than was suggested in the dot plot, or frankly was suggested in the minutes from the Fed's December meeting that were released this week. They talked about how they wouldn't essentially rule out another hike. There was no suggestion that rates aren't going to stay higher for a longer period of time. So I guess, is what changed here, or what could change, more market interpretation than actual Fed interpretation, because the Fed may have been thinking things all along that are supported by this data?
Yeah, I know what you're trying to say here. It is a weird situation.
I'm not sure I succeeded, so please help me, Mike.
I said on television earlier today that the Fed and the bond market are kind of married, but they're not sleeping in the same bed. They're not even sleeping in the same house. They're quite far apart, and that has to change. How it changes will depend on the data. We had a very weird day today where inflation went up in Europe. It wasn't unexpected, but it went up in Europe, and all of a sudden the markets priced out a number of ECB rate cuts. Same thing happened in the United States with the jobs report. They price out rate cuts when the Fed, when the employment numbers came out, and then that ISM number came out, the ISM services, which showed a slowdown in the service industries, a big drop in prices, and an even bigger drop in jobs. That wasn't confirmed by the payroll report, but it was enough that all these markets, futures markets, did a U-turn and now are back to pricing in March moves. So if you can explain the bond market thinking to me, you're doing better than most people. I think basically what you end up with is people are taking advantage of cheap options on the idea of maybe kind of hedging against the possibility that the Fed might actually end up, if inflation goes down, cutting rates in March. Those options may fall off if the data don't support what we're doing, and it's not like you're actually shorting treasuries or something like that.
All right, Bloomberg's Michael McKee answering a question that I'm not sure actually I even asked as a question, but well done, Mike. Thank you so much, as always. We really appreciate it. Of course, Mike, the expert on all things monetary policy, but we want to talk to an expert now on fiscal policy, because as we've talked about already on this program, it's going to be a battle over appropriations, and it's going to start in just a few days when Congress returns to Washington after a multi-week holiday break. The issue on the table, figuring out these 12 appropriations bills by January 19th or February 2nd, depending on what department of the government you are talking about. And depending on who you ask within the government, they may be feeling more or less confident about the ability for a shutdown to be averted. Shalonda Young, who's the White House's budget director, said this morning, "I'm typically optimistic. Don't mark me down as optimistic this morning." So how optimistic is our fiscal policy expert, Bill Hoagland? He is the senior vice president at the Bipartisan Policy Center. So, Bill, how are you feeling?
Thank you, Kylie. I'm feeling cautiously optimistic. How's that? There's good news coming out literally in the last few hours as it relates to an agreement being reached on what we call the top line for appropriations. It is critical for the appropriation process to work the 12 bills to get them completed, that we have an agreement on the overall level of discretionary spending, both defense and non-defense. And there is very strong indications that we are very, very close to getting to that agreement here in the next, it may be even announced later today or early tomorrow. The importance of that is once you know the top line, which we haven't had an agreement since we thought we had the agreement way back with the Fiscal Responsibility Act back last June. But of course, we went through a number of iterations since then. But now we're back to where we should have been back last year. We have an agreement that's being reached that appears to be very close to this Fiscal Responsibility Act agreement last spring. And that will allow then the appropriators to move forward by completing their bills. Quite frankly, I do believe it's very, very difficult, though. Let's be fair, Kaylee. I think it's going to be very difficult in 8 days, essentially 8 days, to get the agreement as it relates to the first tranche, which is Department of Energy, Agriculture, Housing and Urban Development, and Transportation.
So, Bill, even if we do, to your point about the difficulty of achieving all of this in such a short period of time, even if you have the top line figures now, potentially knowing how hard it was to come to that in the first place, how much harder is it to figure out everything underneath, how that money is actually divvied up within these programs?
Well, of course, the Senate committees have been working, staff have been working for some time, the House too. It'll take some time. I guess what I want to say is I think that for that first round of 8 major agencies that has a deadline here of January the 19th, my guess is it's going to require them to extend that agreement maybe into the second tranche, which is February the 2nd. And I think they can get that all done within that time frame. Yes, there's a lot of decisions being made, but I think a lot has been done behind the scenes. So I am, as I say, cautiously optimistic that we'll not have a shutdown for those 4 agencies, but it will require that there's an agreement to extend that first tranche, the January 19th date, to probably to February the 2nd with all the other 8 bills.
Would that extension count, though, as a short-term CR of some kind? Because Speaker Johnson said he wasn't going to do any more of those, but is that, frankly, his only way out of this pickle?
I think it's either that or a government shutdown for those 4 agencies. So I believe that once we get to where the belly up to the bar, so to speak, you're going to be able to work out an agreement. Yes, we make a lot of announcements, and I think we'll find out here. Now, I want to make very clear there's one other issue here. This is just the funding for the fiscal year that we're currently in, fiscal year 24. Yeah. This has nothing to do with the supplemental request that's still pending, $106 billion. This is one that has to do with Ukraine, Israel, the issues around the border. That's still a separate issue to be debated.
Well, I'm so glad you brought that up, because I'm not really sure the border issue is separate to the appropriations process anymore. The rhetoric we're hearing from Republican members of Congress is shut down the border, shut down the government. How much more complicated does this all become if the border security deal is now what is contingent upon keeping the government funded?
Well, then that's a new element here. As I say, I've heard this: shut down government or shut down the border. I think that's a little bit overstating it. Once again, a little bit dramatic in their statements, because we're talking about, first of all, funding the basic government, and then the issues associated with that emergency supplemental. I think you can negotiate the emergency supplemental and the border issues separate and apart from the basic funding of the Department of Agriculture, Energy, Transportation, and Housing. I think those are really separate issues, and I believe that the appropriators and the leadership at the end of the day will separate the two out.
Okay, so even if the issues are separated, though, how hard is it going to be to find bipartisan compromise on this issue? This is an issue that reforms have evaded Congress for literally decades, Bill. So what makes this time different? Is it really different?
No, I think you're absolutely correct, Kaylee, that the issue associated with the emergency supplemental, that's separate and apart from the basic funding. I think that is going to still continue to be very contentious, whether or not they can reach an agreement here. I think it's still very problematic on that score. I do think that there is a real desire on the part of particularly the members in the Senate to find a solution here. And it will not, listen, let's be honest, even if we could find some improvements upon the border, whether it be through the parole issues or other issues down there, I do think that we're not going to solve all the problems of the border in this one particular bill. But one thing that's important is to keep in mind that emergency supplemental was to provide additional funding to the border for exactly for what is needed in terms of the border judges and things of that nature, and the border guards and all that, which are necessary to strengthen the border and protect the border here. So again, I want to try to keep the two separate from the basic fundings of the federal government for fiscal year 24. But you're absolutely correct. I think it's going to be very difficult, and we're not there yet, clearly. But at least the United States Senate, in a bipartisan manner, is trying to work overtime to find a solution. Now, whether even if the Senate could get an agreement, whether that would be acceptable in the House is still very much up in the air, as the new speaker has interjected himself and says that he wants to negotiate directly with the White House. That will further delay any kind of agreement going forward on the border.